Welcome, everyone. I would like to remind panelists, please turn off your cameras and microphones at this time. And also, as you just heard, this session is recorded, so please keep that in mind. I will now pass on the microphone to our president at the Minneapolis Fed, Neil Kashkari, for his introductory remarks.
Thank you, Marco. Good morning, everyone. It is great to be with you at this important conference. We're really happy to be hosting this conference together with the St. Louis Fed to celebrate the 40th anniversary of Tom and Neil's paper. Before I begin, I just want to mention that today is the last day of the FOMC blackout period. We had an FOMC meeting Tuesday and Wednesday of this week, so I'm not going to make any comments about the current economy or the outlook for the economy or for monetary policy. My comments will purely be historical in nature. There's a long tradition of fiscal authorities relying on and working with central banks in times of crisis, mostly during wars, but also during the Great Depression, in terms of trade shocks in developing economies, and of course, recently in the 2008 financial crisis, where I served a role. I was at the US Treasury Department, very involved in our financial crisis response, and ultimately led the TARP program for both Presidents Bush and briefly for President Obama. You know, when speed is of the essence and the fiscal authorities have to go through the legislative process, monetary policy has a very powerful edge in that they can move very, very quickly through traditional policies such as using interest rates, and now in less conventional policies such as bond price support during World War II or quantitative easing during the 2008 financial crisis. You know, the 2008 crisis was very much, I remember, it's burned into me. It was like 9/11 hitting the economy. It was just such an extraordinary shock that none of us were expecting, and none of us really knew how to analyze it. And so Treasury and the Fed worked very, very closely together. First of all, just to understand what was happening. Was this a liquidity crisis or was this a credit crisis, a capital crisis? We weren't sure. I remember, I think it was January of 2008. So the crisis started burning in August. It started simmering in August of 2007, showing up in the housing market and in mortgage funds, mortgage bond funds. And we kept wondering, you know, how bad is it going to get? Is it going to get worse? Do we have the tools to address it? Can the private sector address it by itself, or is there going to need to be some government intervention? I would say that we were all philosophically reluctant interveners. We were part of the Bush administration at the Treasury, and we really believe markets should be able to clean up their own messes. I remember I was on a conference call with Secretary Paulson. I was in his office, and we had a conference call with former Fed Chairman Greenspan. And I remember listening, you know, he speaks softly, listening over the speaker when he mentioned, you know, this may be a 1 in 100-year event. That was a shock to all of us that, you know, that it potentially could get much, much worse. And then, of course, Lehman happened in March 2008. So there was great coordination between Treasury and the Fed, just first of all, in trying to analyze the situation. What is this crisis? Is it just about liquidity, or is it really about solvency? And then it was, okay, who has tools to address these elements, depending on how bad it gets? And so we had, during the 2008 crisis, our lawyers at the Treasury and at the Fed going back through statutes from the 1800s, literally looking for some authority somewhere for the government to intervene. And you know, the Fed has very powerful authorities to provide liquidity, but by law, the Fed has to be secured against collateral. You know, the collateral may be somewhat questionable. That's not clearly spelled out, but they need to be secured. And that ultimately is what led us to go to the, when the crisis really got worse in September of 2008, after Lehman failed, ultimately the decision that Secretary Paulson and Chairman Bernanke and ultimately President Bush made was that we had to go to Congress to ask for the TARP authority, which was the ability to put in equity into banks. So the Fed has very powerful tools, but they're all liquidity based, which is you can lend against collateral. Maybe some of that collateral is a little bit sketchy. You know, you can debate that, but you cannot put in money on an unsecured basis. That's what equity is. So only the fiscal authority had the ability to do that. And so I think much of the 2008 crisis was pushing the central bank as hard as possible. And there was great collaboration again between Bernanke and Paulson, but there was a limit to how far the central bank could go because they did not have the ability to just literally absorb losses by putting in equity. Only the fiscal authority had the ability to do that. And so it was using who had which tool for which part of the crisis, depending on how bad it got. Now, Sargent and Wallace's unpleasant monetarist arithmetic, as well as the rest of their work and what other economists such as Bob Lucas did in the time, taught us that expectations about the future matter a great deal for the evolution of the economy. And I think nowhere is that more true than when the Fed was very powerful in 2008 in embarking on quantitative easing. You know, if you look at all of the models for how quantitative easing works, we've looked at them in Minneapolis, we've looked at them across the Federal Reserve System, none of the models show much of an effect. And I remember former Chairman Bernanke had that very famous quip, very clever quip, that quantitative easing works in practice, but not in theory. So what is that? How could it possibly work? Well, one view of it that I share is that quantitative easing is sending a message about the stance of the central bank, overall stance of policy. And so back in 2008, I think that the Federal Reserve was sending a message of, we are fully standing behind the economy. We are going to use all of our tools as powerfully as we can to try to hasten the recovery. First of all, address the liquidity crisis, but then try to get the economy back to hitting the dual mandate that the central bank had of 2% inflation and maximum employment. And quantitative easing, I think at the time, was a very powerful signaling device, rather than, if you look at all the models of term structures and risk premia, it shows very modest effects. But I think the signaling power is very large. It is clear that the work of Tom and Neil has greatly contributed to show how important an independent central bank is in achieving these goals that Congress has laid out. So in sum, although much research has been devoted to this question since Sargent and Wallace wrote their 1981 piece in the Federal Reserve Bank of Minneapolis' quarterly review, many questions remain open. A lot of great work has been done since then. And I'm pleased to welcome you to this conference to continue that body of research. The papers presented today are not the final answer, but they are going to bring us further insight on these questions that I talked about earlier and that others are going to raise today. And I really look forward to learning more in the coming days. And so I want to once again thank the St. Louis Fed for joining us in this celebration of their work, and thank Tom and Neil for showing us the way. The papers in this conference are a wonderful example of that ongoing legacy. And so thank you very much for including me to give these introductory remarks. And with that, I'm going to turn it back over to Marco.
Thank you, Neil. Those were very inspiring remarks to start. So let me tell you a little bit how we're gonna run this. So the speaker of each paper will have 35 minutes. I mean, the goal is, you know, we wish you were all here with us and experience our usual lively interaction, and we'll do the best that we can given the format. So the speaker will get 35 minutes. During the introduction, please don't ask any questions. When the model is being presented, please limit yourself to clarifying questions. Once we get to the results, actually a few questions are encouraged so that we can make it a little more interactive and lively, the way we like it around here. Of course, if things get out of hand, the chair, which this morning will be me, will put a stop and say, okay, now we're going to defer the rest to general discussion. While you're not speaking, please keep your microphone and camera off. But when you do ask questions, you're encouraged to please turn your camera on, and of course your microphone. If you're the speaker, please be short in the introduction so that we have more time to see and discuss the results. After the 35 minutes, there will be 15 minutes of discussion by the discussant, and a couple of questions there are fair game too. And I should mention that if you're a panelist, please feel free to jump in during the presentations. Once we're done with that, we'll go to 20 minutes that are reserved either for general discussion or for a break, depending on how many questions arise. And there, please, all the panelists, it's great if you actually turn your camera on so that we can sort of mimic the way we would have a conversation, and raise your hand so we can take proper turns in the discussion. If you're an attendee, you're welcome to ask questions through the Q&A. I will be looking at the Q&A, and I will try to select a few questions during the general discussion that I will pose on your behalf to the speaker. And I think that's all all that I need to say. So it's welcome. It's great to have you here. I will turn it now on to Tom Sargent for his first presentation.
This is joint work with George Hall. Okay, so what's the relationship between what George and I are doing and this paper by Neil and me, Unpleasant Arithmetic? Okay, so in the paper that George and I wrote, we start by describing the 6 components that comprised my paper with Neil. And I won't list them here. What this paper by George and me is going to do is we're going to toss out 5 of the components, you know, actually the 5, in some sense, maybe paper components with some economics in it. We're just going to keep one component. And that one component is going to be the consolidated, giving them a sequence of consolidated government budget constraints. And we're going to have one budget constraint. We're going to consolidate the Federal Reserve, the central bank, and the Treasury. That's what we're going to do. And then we're not going to use any econometrics. We're going to use we're going to do pattern recognition, and I'm going to show you some graphs, kind of in the spirit of Ed Prescott's old paper, The Last Picture Show. Okay, so here's where we're going to go. And the spirit, the one equation we're going to, kind of in defense of tossing out all these 5 components and keeping one, we're going to keep the component that Gary Becker kept in his classic 1962 paper, where he showed that just imposing budget constraints, disposing of anything about rationality, still imposes restrictions on data. That's what we're kind of doing in macro. And we're also doing, I'll also give another defense. We're going to do in the spirit of Lars Hansen's, some of his work, although in a different direction. We're going to try to say something without saying everything. Some of the more ambitious papers in this conference, I've looked at them, are going to do much more. They're going to say more by assuming more. Okay, so what this paper is about 3 wars and 3 world wars. And here's the shock. It's kind of an imaginary picture. The shock is going to be I'm just going to say a huge shock to the labor supply. So what this is, here's a graph from 1900 through today. And the blue line is active duty military personnel. And you'll see it's kind of boring, except in World War I, World War II, and well, it looks boring here. But we're going to put something on the same graph. We're going to put insured unemployed. So the shock that we're going to say is, I was in the Army, and what you do in the Army lots of times is you sit and wait. If you're not in harm's way, most people aren't in harm's way most of the time. So this shock is a big negative labor supply shock, and we had a big negative labor supply shock here. So that's the shock that we're going to be talking about, organizing. So we're going to do pattern recognition. I'm going to show you some graphs. They're going to all be organized around the consolidated government budget constraint, and I'm going to stare at them, and that's it. And I'm not going to take 35 minutes. So tell you some of the patterns. I'm going to look at, George Stigler. Okay, I got a quote from George Stigler, but I'm not going to tell you. So the U.S. war on COVID-19, and people talk about it as a war on COVID-19, it shares these features with the 2 20th century world wars. Negative labor supply shocks. I already told you about. It's a worldwide shock. It's a common shock hitting a bunch of countries all over the world simultaneously. There were extensive government restrictions on domestic and international travel and trade. In the US, that's what we're talking about. There's surges in federal government expenditures, and they were largely financed by issuing interest-bearing debt and base money in all 3. And then what's also common is the Federal Reserve both directly and indirectly supported federal bond prices, and it expanded the Fed balance sheets, sometimes in superficially different ways, and often the same ways. So that's first pattern. So those are patterns we know. What we don't know yet is whether the war on COVID will share the following 20th century pattern: permanent post-war increases in government spending as a share of GDP. That's what happened after the previous war, 2 wars. We don't have enough data about that. Say more about that. So those are patterns, a couple patterns, and kind of here's what we find in these graphs. Federal outlays spiked. Show you a graph in a minute. During World War I, II, and COVID, common pattern. In World War I and II, tax receipts increased to cover only small shares of those spendings. So far in COVID, it's covering even a smaller share. After World War I and II, government spending after the war, they fell while tax revenues remained elevated. Show you a little bit. So government ran a primary surplus for a number of years, more striking after World War I than after World War II. So I'll say more about that when I stare at the pictures. Next pattern. Well, I already mentioned World War I and II were followed by permanent increase in federal expenditures as fractions of GDP. The Biden administration and the White House numbers say that they want this to be true, but we don't know yet. And finally, I'll just go. Okay, so we're just staring at pictures. There's U.S. federal government expenditures, net of interest. Those are net of interest. There's government expenditures, net of transfers, and net of interest payments. So these are, and then there's total tax collections from the Treasury. They do not include money creation. And so the numbers stop in 2021, and then there's some numbers here I'll come back to. So stare at this. And actually, when I look at this, I think of a Hansen-Shankman multiplicative process, and I'll come back to that. So what you notice, surges in expenditures during the wars. Look at World War I. And this kind of looks like a Barrow tax smoothing model. So during the war, big government deficits, something's happening, bonds are sold and money's printed. And then after the war, there's a gap here. Actually, the gap goes on until after the Depression starts, and there's a net of interest. There's a net of interest surplus. And then here's the Great Depression. And then here's World War II. What you'll notice is government expenditures, there's kind of a permanent jump to this level. Here's World War II. Same thing, big deficit during the war. The war goes longer. If I showed this for Britain, this would even be fatter. For both of these would be fatter. And then after the war, well, Harry Truman, he started copying what Coolidge and Harding did for a while, and then okay, so you see this. I'll come back to this. So there's some surpluses, but not as profound. Something's happening after this. So on average, not too big a net of interest surpluses. And then here's COVID. By the way, the financial crises are there's the financial crisis. And here's the Great Depression, and then here's COVID, and then these numbers are the forecasts. They come from the White House for whatever weight. So now I'm going to show you another graph. I'm going to take a and this is influenced by Hansen-Shankman multiplicative processes. Because if you live in their land, if you want to learn anything from the data, you're going to have stationarity and ergodicity. somehow you're going to have to get it in. So let's take a difference and hope for some co-integration. And all this is this the difference between G minus T. So it's the primary deficit. So look at that. We're running a tight ship before the war, big deficit. Then during the 20s, and this is what a Barrow tax smoothing model tells you to do. Run a primary surplus to service the debt. Maybe not retire it, but don't let it grow. There's the Great Depression. Here's World War I. Here's World War II. Harry Truman copied a little bit, and then kind of averaging to zero. Maybe we run. There's Bill Clinton, and then here's where we are today. And then we want to know what's going to happen here. Okay, so I'll show you some more patterns. So this graph has implications about what's happening to the debt. By the way, these are percents of GDP. These are percents of GDP in the Hansen-Shankman, multiplicative process tradition. Okay, here's the par value. Okay, par value. So that means it's mismeasured. It's not marked to market. I'll come back to that. Of U.S. Treasury debt, and there's something fishy right here that Marco Bossetto has taught me in the way this is accounted for. This is par value of debt, and this is by ownership. So I can spend a lot of time staring at this. So there's used to be a domestic. It used to say we owe it to ourselves. We owe it to ourselves if this yellow thing isn't too big. So you can look at this. Well, what you'll notice is, in the 20s, this is being paid down. That's a net of interest surplus, which is doing that. Not here. Okay, so somehow it's being paid down, but it's not the net of interest surplus. Something else is going on. It's either seniorage, or you're growing your way out. Again, these are percents of GDP. And then, okay, we could, I'm weird, but I can spend a lot of time looking at this graph. Okay, so here's a table that in the paper. I'm not going to spend much time on this because I'm just going to tell you it's in the paper. There's other tables. So here's Fed balance sheets during the three wars. And there's assets and liabilities. There are decompositions. There's some really interesting things about these during the three wars. And here's this one. Look at this. Come back to this. And there's more there. So paper, we stare at this and we look for patterns. And then I'm going to spend a little time on this. Here's the par and the market values of Treasury debt. Because, what I say here, those were par values, but that's not what belongs in the government budget constraint in macroeconomic theory. That's not what Neil and I had or anybody has. Okay, they have the market value. So George Hall and I have constructed the market value from 1776 to today, and so the reds the par value, the blues the market value, and actually they track each other. There's kind of no reason they should track each other unless the maturity structure and the coupon structure that the Treasury chooses to issue is of a certain kind. And Vivi Chari taught me this. There's a story about that. Why do these track? There's periods where there's big differences. The difference is capital gains and losses, and the Fed and the Treasury, or actually it's OMB's way they record the par value. Anyway, so then here's what's happening. Okay, then here's what happens here. Two new lines appear. And what it is in November 2008, the Fed started paying interest on reserves. So now read footnote. If it pays interest on reserve, those excess reserves are federal debt, and they shouldn't be counted as they should be counted as IOUs. Okay, so but now you go back to the real bills doctrine. What did the Fed do with quantitative easing or unconventional? Unconventional policy isn't actually unconventional. It was written into the Federal Reserve Act. You know, the Federal Reserve Act, the Fed's not supposed to touch treasuries. What it can buy is commercial paper. Safe, you know, it can buy real bills. So, you know, when the Fed starts paying excess on reserves, it's using it partly to buy treasuries. So the sum of these two is treasuries plus private stuff, mortgage-backed securities and stuff like that. So this stuff, the gap between the blue, the green, and the light blue, that's real bills. So those are backed by interest earning things. They shouldn't be counted as federal debt. So this is a back of the envelope calculation. Okay, so then the rest of it, Tim Kehoe's his talk is going to have a lot more budget constraint. Here's our budget constraint. That's what we're recording. In the paper, we describe how that's interest on the interest payments on the government debt, which is recorded wrong in the national income accounts and what the Treasury reports. Wrong from the point of view what Neil Wallace told me to write down when he told me the government budget constraint. Okay, so that's what here. And then we do a decomposition. We do a decomposition, and the purpose of decomposition is say, you know, it's Keynes's remark: what the government spends, people are going to pay for it. So we talk about the evolution of the debt GDP ratio, and what drives it is the primary deficit, money growth, or inflation, or growing your way out of it. So George and I, we have decompositions. And then I want to hear Ramon. Here's decomposition of wartime revenues. If I didn't want to hear Ramon so badly, I'd do some circling. And then, oh, here's the final thing. So pattern recognition. George and I write down the log of the consumer price index during and after the wars. So, you know, big rises during the war. And then that's World War I. After the war, it falls, and it actually was going to fall a lot more if Franklin Roosevelt didn't pull us off gold. He wanted to reflate because Irving Fisher told him to reflate, because he wanted to redistribute between borrowers and lenders. Here's World War II, and here's where we are with COVID.
Tom, are you measuring this from the start of the war?
Yep.
Is that the way it goes?
The start of the wars. So look at the scale here. Look at the scale. This is a funny start. So these graphs, yeah, start of the war. Okay, now here's the final thing that I want to conclude with. Here's the real value of $100 portfolio of Treasury securities invested at the start of the war. So here's World War I, and actually, this bothered Harry Truman. We have a section. This bothered Harry Truman because he was a patriot fighting in France. He also bought war bonds. They got crappy return until Franklin Roosevelt, until the Great Depression. Then they started getting really good returns. Franklin Roosevelt said, way too big returns, and he wanted to flatten them. And here's World War II just did this. You got bad returns. And here's what's happened so far. And then finally, I'll just conclude with this. So there were capital losses in both of these wars. Are there going to be prospective capital losses now? And how are they going to be distributed? And I'll just conclude by saying after World War II, focus on that, the losses were imposed on private investors. That was a component, not the only component, of how we paid down the debt. But today, for reasons that we describe in the paper, a similar size inflation would probably hit the Fed's balance sheet and the Social Security Trust Fund much harder. And then to analyze that risk, which I think it's really important, and its consequences when the Fed pays interest on excess reserves, as it now does, I think it would help a lot to abandon this this single consolidated government budget constraint and go to a 2 or more budget constraint framework, like Bassetto and Messer and Chris Sims and other have been advocating, to keep track of decentralization between the Fed and the Treasury and the tensions that creates.
So we're going to have plenty of time for a discussion. We'll let Ramon lead us, and then we'll see where it takes.
Thanks for having me here. Actually, I wish I was there. This was my last flight to the US. I was going to St. Louis, to a conference, actually St. Louis, Federal Reserve Bank, with some people here and there, like John Cochrane, Neil Wallace. So John was giving one of these talks about the history of the world according to fiscal theory, the price level, which, as you know, contains any macro theory you can think of. So I went out with Neil and for a walk, and said to him, actually, I think that the stuff of Tom with George Hall on the history of US debt is quite interesting. And Neil replied, well, I say to Tom, where is the model? So this paper addresses Neil's question. So as Tom already said it, they mentioned the 5 elements of their paper. And then they say, okay, we drop these 5 elements and we just keep the consolidated government budget. There is no model. So this is like the 6th episode of the series with George Hall that started in 1997. So it's almost the 25th anniversary of Tom as a public accountant. And then we have a quite interesting series, as I said. Immediately previous to this one, it goes over 8 wars and 2 insurrections, but it doesn't cover COVID, but they're very closely related. So being at Minneapolis talk, like all the students from there talk about takeaways. So I will say there are 3 wars, 3 takeaways, and 3 challenges. I'm just gonna briefly talk about these things. Well, the wars, you know which ones they are. That's an important aspect of the paper, which is accounting properly. First, about thinking wars as a huge misallocation of human resources, as Tom was saying. And also being very clear whether what is debt and what is money and whether it pays interest or not. And then, of course, there can be issues, as Tom was mentioning, that if something that was not getting interest, like deposits, it starts getting, that changes the nature. It also is about adjusting fiscal accounts properly. And I'm not going to go into details, but the appendixes of these 2 papers and so on are very interesting, and one can learn how to do it. So here's the picture you already seen. It's fun to see these pictures, but I think this putting together both COVID and the wars has been very clever because of the features that he just mentioned, okay? But also as we can think too, and we'll come back later, and in this crisis that, like in families, some go to war and the others stay. Some get unemployed and others just get a paycheck and save. If one looks further back on the picture, and then we get this whole story of liars and receipts, and that's Tom already talked about this, so I'm not going to look at more, but we can go even further back in the previous paper and look at the different wars. And that pattern that Tom was saying is even more clear in the even later in the previous wars. So it's in a sense is a little now that we are here that we are getting more deficits than usual in the past history. So here's the budget and here's the decomposition. So here is the central takeaway, how the three wars have been financed. World War I, it was like Barrow's model, as he is saying. So you pay with that and some small part in taxes. You just go completely away from that, and it's basically money financing. And on that, COVID is different. So here we have, yes?
This came up with in Sargent's talk. It's different, but this is interest-bearing money. And during World War I and World War II, it was not interest-bearing money.
Good point. Good point. That will come back to that, yes. Although, okay, they do make this decomposition. There's an aspect which is pure debt, if you want to call it, and the other which is not so pure, and it's put in money. Again, if we look at the past history in the previous papers, there is also a difference. Before was all private investors, which now it's not, as Tom was emphasizing. But it has not been just before COVID. So the picture at the start of the war is fairly different than the picture of the start of the war, World War I, World War II, and previous. Same has to do about the debt composition. And Tom already mentioned that. So now it's no longer just simply the private investors, but we have these foreign investors, government agencies, and Federal Reserve, which has also, of course, translates into a different balance sheet of the Federal Reserve. There is a difference, not just of the war per se, but what happened here. I mean, their practices from central banking start being different with the financial crisis. So that preview was something other wars didn't have, and this one had. So here's the warning. After World War II, losses that is lifting the price of controls and subsequent inflation imposed on holders of federal bonds fell primarily on private investors. Today, a similar size, it will probably hit the Fed's balance sheets and the Social Security Trust Fund much harder. Among other reasons, because US debt is fairly short-lived right now. Actually, that's a difference with European debt. And also because private investors have many other things to do with their money as they had before. So that's the warning. Now, let's look at a moment again to this primary deficit that we show. And we can just do standard flow of government debt, like Tom does, like Cochrane and everyone does. So here is the value of that as the present value of the primary deficits, and the interest rate, inflation, the growth, and the primary deficits, minus S, the surpluses. So this will be a Cochrane backward perspective saying, well, if we put it in the 1930s, so the value it had, properly scale in lux and so on, and that's the value of that, how it goes. And then we look at these components, and then we look at the component at a time, meaning what if only primary deficits play a role and the others were zero? Well, we will be much, much higher. But what is this red line? This red line is 40 years ago. So things look quite different, actually, because we just had gone through this period of R minus G doing the job. Still not fully, because they still were the primary deficits, but then after that, they just keep increasing. Not only with the crisis, but after the financial crisis. So that's a different perspective. And then it's not obvious that the R minus G negative will do the job as it did in 1940 or 80s. The pre-war COVID debt was very high. And also looking ahead, we're going to have more aging population, climate shocks, and so on. But also, assessing the present value of future surpluses is not a trivial thing. Well, Tom knows that. They weren't econometrics, but he had done stuff on that many years ago. Or about demographics of Social Security. One important aspect of the paper, of the 40 years old paper, is it says, one way the public demands for bond constrain the government is by setting an upper limit on the real stock of government bond relative to the size of the economy. So that's, the red line again is how it looks when they wrote that. I don't know what they thought about upper limit. I don't think they thought that will be below the upper limit where we are now. But also because they are just talking about public demand for bonds, which was correct when it was all private investors, but now, as we know, there are many other players in the game. Foreigners, but also, government agencies and the Federal Reserve. And again, as I said, that's how things look different in the Federal Reserve buying liabilities. Look at how it looked when they wrote the paper. So things square much clean as they do now. Now, domestic private investors are minority shareholders. The upper limit, it's not the demand, it's anything here, the future value of primary surpluses. So the transmission depth of money is not as immediate as it was. And actually, some monies and debts are becoming transgenic. So who does the fiscal and who does the monetary is a blur somehow. I mean, the Treasury and the Fed, they cooperate, as it was said at the beginning and the opening statements, but the game is more subtle, as also as Marco said was saying. And look at what happened with this thing that Tom was worried. So he didn't see the whole picture until, so now is yesterday's threat. So boom, they just disappear. Actually, this was like a main thing in the crisis. And at that time, this graph looked like in a different scale, amazing. Well, now that's peanuts what happened, but this had been growing. Okay, so I'm talking about deposits of the Treasury and the Fed, and how they scale went now. Okay. Well, what happens with inflation in the while or something? But also the challenge is about this upper bound business, okay? Well, some people say, no, don't worry, with R minus Z negative, we just can have a stable bubble, and we just need to add a bubble to the equation. Here's a quote or a paper. So I don't know what Tom would say about that, because you see, bubbles were not stable or learning equilibria in the all arithmetic, or robust decision maker will not play with that. However, if you are too cautious, like Truman did, with only using taxes, that may be an inefficient self-confirming equilibrium. So the final is about what is the objective function. It's not only about how we consolidate the budget or not, but certainly that is not a single agent. I mean, in that sense, what I said before, in the World War I, this idea of the family, that one kid goes to the war and the other stay, I mean, it's tragic, but at the end, they just put together. Now we are not in this situation. So we definitely have to look at models where we have not single agents or families or incomplete markets, but Tom knows that. So Neil, actually, I think that the stuff of Tom with yours is interesting, even if it's no model yet. Thank you.
Thank you, Ramon. That was a great discussion. So John has his hand up. John Cochran, please go ahead. And if you are panelists, if you can turn your cameras on, now we can have a discussion.
Well, I knew I had to hit that button fast if I was going to get any chance of getting a question in after this fantastic set of slides. I'm sitting there poised, so thank you. I'll try to ask a short one. each of the three wars have this interesting feature of a sharp bout of inflation. So we should talk not just about Barrow, but about Lucas and Stokey. So the sort of three questions there. One, it would be great to have kind of a breakdown. How much of the debt was repaid by surpluses? How much by state contingent inflation? How much by financial repression of low rates of return? But Lucas and Stokey tell us you're going to have the state contingent default at the beginning of the war. You default away on the outstanding debt because you can't expect a future state contingent default. Yet in each case, we had the state contingent default just after the war. A lot of people are saying now, hey, this is great. 20% cumulative inflation. We'll have our state contingent defaults exactly what you're supposed to do after the COVID recession. But it raised the question of how. The inflation isn't directly under anyone's control. Why didn't 2008 have a state contingent default? So maybe you have some idea of who's deciding whether we do the ex post. So question number one is, how can you have a state contingent default after the war? That doesn't seem to fit theory. Number two, who's deciding it? And number three, you're remarkably silent on the policy issue of the day. Olivia Blanchard said, ours less than G, don't worry about it. It has no fiscal cost. Janet Yellen said, I think it was in January, interest costs on the debt are next to nothing. Don't worry about it. We can spend all we want. We'll just R minus G our way out of it. Maybe we read the inflation we're seeing now as everyone else saying, there is a constraint. If you guys don't have a plan to pay it off, maybe we better devalue it. That was the end of the question part, so it was shorter than usual.
Tom, would you like to respond?
I don't think so when John, when you said I was silent about things, so one of the Psalms of David says, you never have to explain what you didn't say. So I'll kind of stick with that. Yeah, you raised lots of issues. You make comments about theories like Lucas and Stokey. Yeah, there's a reason we mentioned Barrow. In terms of I don't really have much to say online because we'd have to have a coffee and discuss this. But Ramon, your comments were really they were really kind, and thanks for trying to protect me from Neil. They're pretty funny comments. Neil didn't actually. Neil, in terms of where's the theory, if I start showing him the theory, he's going to like that even less. I guarantee you. Okay.
David, you're next.
Yeah, thanks, Tom and Ramon. Very interesting. So, Tom, I will ask a question that you did make a reference to, and that was in terms of the present day context with the Fed holding a significant fraction of the outstanding stock of treasuries. That today it's a bit different. That it's the Fed that's exposed to this risk. And I have to admit, I'm a little bit at a loss as to what you think the significance of the Fed holding this treasury portfolio is. I mean, you're imagining, say, a sudden increase in the price level that devalues the nominal value, the value of the assets on the Fed's balance sheet, and the Fed should care about this because I'm not sure I follow why this is significant, and maybe if you could elaborate on that. Thank you.
Okay, so it doesn't matter. I don't. I like your question and your comment. It doesn't really matter what I think. I mean, fortunately, I'm not a decision maker, so I read Marco Bassetto's. So maybe I'll just say I don't know what to think. I read Marco Bassetto's paper on 40 budget constraints, which was talking about the prospective distributions of risks for an arrangement that they have for sharing risks, but the description, the description of the arrangement is incomplete and very complicated. So then the way Marco and his co-authors paper goes is they stick their neck out and start answering questions like they describe various scenarios, couple scenarios, kind of completing the arrangement that have important consequences about the distribution of risk, of ex post distribution of these risks across countries. So I just don't know. Kind of Neil's comment about well, where's the model? If historic pattern, if you're not doing anything new, and I can just use machine learning and stare at thing and say the future patterns are going to be the same. But when we go to uncharted territory, I don't know. I don't have a model. I kind of need Bassetto 2002 on steroids to answer your question, and I don't have it. Sorry.
So you'll have to let me know where I should wire money for the bribes for keeping citing my work. Chris Sims is next.
I have one comment on this last round of discussion. Marco Del Negro and I have this paper on the Fed balance sheet where we consider scenarios in which the Fed has big capital losses that make its balance sheet formally look like like assets are lower than liabilities. But we tried to see what kinds of scenarios could actually make that a problem for the Fed, in the sense that it would need a bailout it would need a Treasury injection of capital. And there is this simple regularity that helps to ensure the Fed, which is that the Fed's actual assets, in some sense, include its ability to collect seigniorage. And so the same kinds of shocks that produce high interest rates and hence capital losses on long debt on the Fed's balance sheet tend to produce high expected future seigniorage. So it's a little hard to construct a shock that actually leads to the Fed needing to go to the Treasury for capital injection. We did construct one. It's what we call an inflation scare. That is a situation where inflation doesn't actually materialize. So there's no gain in seigniorage, but there's a market's fear of sudden inflation or future inflation. And the result is that the Fed does have to raise interest rates. And that could produce a capital loss and no corresponding gains from future seigniorage. But it looked like a pretty unlikely prospect to us at the time. Of course, since then, the balance sheet of the Fed has gotten much bigger, and we haven't tried to recalibrate and ask what shocks would produce a problem. My second question is a technical one. Tom, you and George have this great series on the debt, including the market value of the debt. The Dallas Fed has a market value of the debt series. Of course, it doesn't go back nearly as far as yours. Is this significantly different from yours? Is there a reason to prefer one over the other?
Let me, I think.
Perhaps I can answer that one.
Yeah, take it, George.
Yeah, so our measure of the market value of the debt tracks the Dallas Fed's series quite closely. Ours goes back further, and we can kind of slice and dice the data a little differently than they do.
Ricardo? Or
Hey, could I say something about Chris's comment?
go ahead, yeah.
Yeah, the reference to the paper with Del Negro is on the money. And you're mentioning inflation scares. I've been rereading William Silber's book, Volcker, his biography of Volcker, and a paper, an associated paper by Goodfriend and King about the incredible Volcker inflation, disinflation, and it's all about inflation scares, which Volcker is struggling with. So anyway, hopefully, anyway. So it has happened.
Ricardo?
Tom, could I ask you to think through with us how the presence of foreigners matters across the three wars, because it's changed quite a lot. And, they're a big source of potential revenue or taxation from the perspective, at least, of the US government or US as a country, because you go to World War I and the dollar is not used outside of US borders, and no foreigner lends to the US insofar as treasuries aren't held abroad. And so you see that, and you see a certain pattern of payments, as you said, in the 1920s with losses in the value of the treasuries that's really being borne by the domestics and the pattern on surplus. You go to World War II and the dollar is being used abroad a lot, but no one's holding treasuries outside of the US. And you see a different pattern in terms of how much you used inflation and by connection, of course, the exchange rate as opposed to surplus. And now you move forward to this one, and this showed in your pictures. And now not only is dollar used abroad, but a big thing that was very noticeable in your pictures is how much of a share of the debt is held by foreigners. And so the foreigners, both through the exchange rate as well as what happens to the returns of the debt, could be a big source of revenue. So can you extend your analysis on the spot, or maybe not, to kind of think a little bit about the fact that you have now, there's this other agent that has grown in both in terms of the use of the dollar and the effects of inflation, as well as the being holders of the debt, and how we should think about this in the context of your framework? Thanks.
Actually, I would prefer not to, because what you've raised is dynamite, and it's been thought of before. There's the German Chancellor Strassemann during the 1920s basically said, it's in our interest to borrow a lot from the Americans, because once they owe us a lot, once we owe them a lot, they're going to want to make sure that we do okay and that we don't walk away. So that's been that extra power that the foreign anyway, you see where I'm at. And then other people have expressed your view kind of less diplomatically. Peter Garber, 20 years ago, he was involved with some papers. Why are the Chinese holding so much U.S. debt? And he had a story which has about anyway, you go look at his story, and then maybe it's not fashionable to mention this, but during the 2016 campaign of candidate Trump, now former President Trump said, "Oh, we don't really have to. People renegotiate all the time." So that's been on people's minds, And okay, anyway, so be quiet now. I'll be.
Kjetil?
So you pointed to Barrow. So you showed that after each war, in connection with each war, the taxes increased kind of permanently, and you also showed that spending spiked during the war, and then they returned, but not to the same level, to a level above that. So if spending has discretionary component or some choice in it, we should expect, I think, the opposite, that namely that spending should return to, if you just take pure barrel, should return to a level below the previous level. So, but it seems also in the graph that Ramon showed that it goes much further back, that you see that much more clear, that after each war, you see spending increase kind of permanently in steps.
Yeah.
That's cool. What are you thinking about that?
Doesn't matter what I'm thinking about. It just happened. So if you read history, so here's something to read. You could read about the first progressive movement in the United States during the 1900 to 1920. They were progressive. Heroes of my youth, maybe some they still are. John Dewey, Richard Ely, Walter Lippmann. They various countries during World War I, they had huge huge collectivist measures. And the people I just cited said, this is great because we want, and they actually wanted the war to go on because they said, we can expand the government and get in all sorts of activities, change the whole structure. They wanted that to happen. And anyway, so, during wars, actually I mentioned this kind of to make fun of Neil and me in the introduction. George and I mentioned this. It's like one of the components Neil and I had was rational expectations. But Milton Friedman, who was hesitant about rational expectations, he talked about the law of unintended consequences. You get into a big crisis and decision makers do things and they have enduring consequences that they never anticipated. And big wars are like that. World War I, World War II, World War I, there's no winners. Anyway.
Thanks.
Ramon?
Just a comment on this foreigners business. When I put the list of all the series of George Hall and Tom Sargent, one of them, I just put it in gray because I think it's dangerous. It's called Complications for the United States from International Credits, 1913-1940. The bottom line is that we Europeans, we never pay back. So you should not talk about that when you come to Europe, please.
Yeah, that's a variation on a theme, so there's this, there's a book by a historian named Schuker, and it has this clever title, which is true. It's called American Reparations to Germany after World War I. And it just does the accounting. And
so I have a question of my own. So one thing that is very different between the two world wars and COVID is that most of the spending was transfers. We didn't send lots of tanks. I mean, we did spend on vaccines and protective equipment, but that's small potatoes. Do you think that's going to make a difference for how interest rates are going to look forward? And I think people that are working currently on heterogeneous agent models will have a lot of thoughts about that too, especially because transfers didn't go to everybody in the same way. What are your thoughts about that?
Okay, so I'll just tell you why I don't know. I think it's a really important thing. And here's my text for it. It's Prescott's Ely lecture, where he has a story about he has a story about why Europe is depressed relative to the United States, and it's all high taxes. If you read a footnote, you kind of ask, he's got a model in which he's got a model with a particular labor supply elasticity, according to which that shouldn't happen, depending on how if Europe taxes more and spends more, Prescott doesn't get his result. So what does he do? He he taxes and gives transfers. He gives everything back lump sum transfers. So he manipulates the wealth effect. It completely accounts for his result. So that's a long-winded answer to your question. Does it matter that these are transfers and not just thrown in the ocean? And it's got to matter a lot. And I'll think about it.
So we have a couple of questions from the audience. One is asking, did the government have really any alternatives to what they did during any of to finance any of the three wars?
Yes. They talked about it. You could read William Gibbs's Magadoo, Wilson's Secretary of Treasury's biography, and he talks about how he decided about the fraction that should be financed by government debt versus taxes. He thought about it, and by the way, he looked back at the Civil War, and he thought he could do better. And then, so they did have alternatives, and they made choices, and often they look back at previous wars. Same thing in World War II. This involves a Fed. Fed policy was very different in World War I and World War II in ways that affect the accounts that we report. When you see the World War I, lots of it was financed by debt and not by money creation. Well, if you drill down into that, the Fed had a borrow and buy policy. The Fed's using the discount window in a huge way that was atypical anyway. So they had lots of choices.
So the other question is, if the Fed effectively is the ultimate backstop to ensure that no default occurs, the question explicitly mentions what happened in March 2020. Is there any other constraint other than inflation on the government budget?
The answer is yes. I'm just going to say Will Roberts and Steve Quinn have a book it's an economic history book about the Bank of Amsterdam and how one of the first banks and how it evolved. And they had two parts of that bank. Okay. And there are analogies between those two parts of that bank and the repo market. So that things go on in the repo market. People are creating dollar liabilities that have consequences for the Fed, and they're not part of the Fed. Anyway.
That was a great session. Anyone has any further questions? Okay, so then we'll take a 10-minute break. We'll be back at 10:20 for Cristina Arellano. Welcome back. It's great to have my colleague Cristina Arellano next. And the floor is yours, Cristina.
Well, thank you very much for the invitation to present this paper. This is joint work with Mark and Manuel, who are in the audience. Let me get my phone here ready. So it's just a pleasure to be celebrating Unpleasant Monetarist Arithmetic, this paper by Tom and Sargent and Neil Wallace. And also let me say that the views here are our own and do not represent those of the Federal Reserve Bank of Minneapolis or the Federal Reserve System. So we are living in a world with low interest rates. As Mirotra and Sergeyev have documented, sort of average interest rates below growth rates is not a rare phenomenon. It's been a feature of many advanced economies for many years. So what we're gonna be studying here is sort of in this low interest rate world, what is the role of government debt and fiscal policy in general? And this is motivated by the many academic and policy discussions that we've all engaged in. We're going to be studying this question in the workhorse macro model of Bewley, Haggett, and Ayagari, where heterogeneity and incomplete markets gives incentives for people to save. And these increased savings incentives is a force that lowers interest rates. So we're going to be thinking about this environment, but we're going to make it a bit more general. We're going to allow for general heterogeneity in terms of preferences and in terms of stochastic processes. And we're also going to allow for a wedge between the marginal product of capital and the interest rate that arises due to markups. We're going to be considered simple policies. So the government is going to have linear taxes, lump sum transfers, and government debt. And our policy guide is going to be, we're going to be looking for policies that result in robust Pareto improvements. And these are Pareto improvements that must make any potential agent better off in every state and time. This is going to be, this is a higher threshold, a higher bar for policy intervention than the typical utilitarian metric. But it's going to be useful because it's going to require limited knowledge in terms of individual preferences and risks. So we are going to provide sufficient conditions for the feasibility of robust Pareto improvements. In our environments, interest rates are going to be less than growth rates, and that is going to be consistent with scenarios with capital overaccumulation or without that. So scenarios where capital is above the golden rule or when capital is below the golden rule. We're going to start by proposing a policy that is going to work for all these scenarios. This policy is going to consist of keeping the capital level constant and issue debt. And we're going to show that a robust Pareto improvement for these type of policies may exist, and the feasibility is going to depend on the elasticity of aggregate savings. So when the aggregate savings supply is sufficiently elastic, then the robust Pareto improvement is going to exist. And this is going to be a sufficient statistic that aggregates all that we need to know for the feasibility of robust Pareto improvements that aggregates the heterogeneity. And the policy, this type of policy is going to be useful because it's going to improve risk sharing. We're also going to be analyzing policies in scenarios when when there's overaccumulation of capital. And we show that robust Pareto improvements in that case always exist. The type of policies that we're going to propose are ones where capital crowds out debt, and that is going to allow for an expansion of resources for consumption. When capital is lower, we're going to find that robust Pareto improvements that crowd in capital may exist. And these are going to be useful because those that extra capital is going to potentially expand resources for consumption. But we're going to find that these type of policies are associated with fiscal costs that tend to be higher early on the transition, and for which government debt becomes very useful. Government debt is going to allow for smoothing of this fiscal cost, and debt is going to allow this capital crowd in, which means that debt and capital are going to become complements. But the feasibility of whether or not robust Pareto improvements are a possibility is again going to depend on this elasticity of aggregate savings. So our paper fits into a large literature. Many of the contributions are of people that are here now with us in this conference. So we build on the contribution by Ellen and Ayagari, also a lot on the contributions that Tom has with Anmol, Evans and Golosov, Also contributions by Heathcote, Storsolet and Violante, Bassetto, and many others. So we're very excited to be here with all of you to give us comments and views on our paper. Okay, so let's move on to the environment. So this is going to be easy because it's an environment that we all know and love. So, we're going to omit population and technological growth. So we're going to be focusing on an environment where interest rates less than growth rates are negative interest rates. There's going to be a continuum of heterogeneous households that have idiosyncratic income risk of two sources. Z is labor income risk and theta is profit income risk. And these households are going to face a standard budget constraint where consumption and where the resources from labor income, profit income, asset income and transfers is used for consumption and for savings. I should say that we are going to allow for these idiosyncratic shocks to be idiosyncratic in realization, so they could vary across agents based on the realization and also in terms of the processes. Households are going to be able to save in a risk-free asset subject to a borrowing constraint. And preferences are going to be over consumption and labor. And we're going to consider the case that there are no wealth effects for labor supply. The problem of the household is going to be straightforward. Households are going to choose consumption, labor, and savings to maximize expected value, where we are going to allow for recursive utility with, again, preferences that could also be household specific. In terms of firms are going to operate at constant returns to scale technology, and they're going to purchase factors, capital, and labor in a competitive. So they're going to pay the factor prices, which consist of after-tax prices for capital and after-tax prices for labor. So these linear taxes are being levied for simplicity on the firm side. Firms are also going to have market power on the product market, and the choices are going to be such that the marginal product of capital is going to be equal to the markup, this mu parameter, times the marginal cost, and a similar condition for labor. With markups, there are going to be profits, and there is going to be a profit tax here that is applied on the profits of the firms. So a note on capital overaccumulation. So think about for a second a situation when
Christina?
there's, yes?
Can you very quickly tell us why you have the markups?
Yes, so this is going to be on the next, exactly, I'm going to go into that right now. So absent policy, okay, suppose taxes are zero, then the marginal product of capital is going to be equal to the markup times the return on capital, which is going to be in equilibrium equal to the interest rate plus the depreciation. If there are very low markups, so for example, no markups, and we focus on environments that gives negative interest rates, that is going to be a scenario where the marginal product of capital is less than the depreciation. And that means that the economy has overaccumulation of capital. Capital is above the golden rule. But that is not going to be the case. We're going to have scenarios where the capital is to the left, less than the golden rule, if markups are high enough. So markups allows us to think about these multiple scenarios for the position of capital in an environment with low interest rates. In terms of the government, so the government, I already told you there some of the instruments. So it sets linear taxes on firms, it issues bonds, and it rebates back its operations from the tax revenue and the debt revenue as transfers to households. So, tax revenues are going to be the sum of the revenues collected from labor, capital, and profits. And then the revenue collected from debt is going to be sort of this revenue from the debt issuances. And think about, we're thinking about negative interest rates. So this is going to have a flavor of seniorage revenue. So that's the setup. We're going to be thinking about.
One quick
yes.
question. Profit risk for the households. What is profit risk? What is
this? You should think about a shock that is sort of a shock to managerial talent that is going to change the share of the profits that they can get. And the only restriction, of course, is that all the profits, at the end the sum of those shares are going to be equal to 1. The 3 market clearing conditions here are so the asset market clearing, so the total savings from households are going to be equal to the total savings from supply from capital and debt. Labor market clearing, again, the total labor supplied by households is going to be equal to the labor demanded by firms, and resource constraint. So we're going to be thinking about an equilibrium where there's a given sequence of fiscal sequences of debt and taxes. Given these sequences, households are going to optimize, firms are going to optimize, transfers are going to satisfy the government budget, and markets clear. Okay, so that's the model. So now we're going to get to work and show you how we are engineering a robust priority improvement. We're going to start from a laissez-faire equilibrium without any government policy. And that equilibrium is associated with initial factor prices, sort of initial wages, interest rates, and profits. In the paper, we also discuss how to extend this to the case where the initial equilibrium has government debt and distortionary taxation. But here we're just going to take this laissez-faire as the initial starting point. The government is going to announce a fiscal policy plan that consists of sequences of debt, linear taxes, and transfers. And the households, given this plan, this fiscal policy plan, is going to re-optimize. For a second, let me show you again the government budget here. Government budget is going to consist of the income is going to consist of these 4 different terms. And so we are going to be looking for the type of policies that we're looking for are those that are robust priority improvements. And we define them as those policies that expand the budget set for households at every point in time in every state. So what this means is that we are going to be looking for fiscal policy plans where the wages that result after the fiscal intervention are higher than the laissez-faire. The profits that result from and the intervention is higher or equal than the laissez-faire. The same thing with interest rates and the same things with transfers. So these are sort of robust priority improvements are those we're going to be looking for policies that expand the budget set.
Christina, just in
Yes?
terms of notation, the laissez-faire equilibrium presumably had some sequence of wages, rental rates, and profits. Are you thinking about a situation where you're starting in a stationary equilibrium of that kind?
Yes. So this is for simplicity. We're going to be starting in the steady state of that laissez-faire equilibrium. That is really without loss, but this just makes the notation simpler.
Sure.
A couple of notes on the type of robust priority improvements we're considering. So for the talk, we have set the borrowing constraint to 0. If the borrowing constraint is not 0, then sort of the robust requirement as part of the robust priority improvement is that the transfers have to be big enough to compensate for the change in interest income that borrowers would face. And the second thing is that we are going to be focusing on policies that are consistent with stable wages and profits. So the wages and profits in the new fiscal plan are going to be constructed so that they are exactly equal to the laissez-faire level of wages and profits. And that is going to allow us isolating the role of interest rates. Okay, so
does that mean, Christina, that you have too many instruments?
No, it's too many. No, we're not going to necessarily have too many instruments. We are going to be having these restricted policies. We could think about policies that allow for changes in wages and expansions of wages and profits, and that would relax the set of feasibility of robust priority improvements. But sort of it's useful for us to isolate the role of interest rates by sort of restricting this to be equal to the laissez-faire. We can make a little bit more progress with these stable wages and profits with after the policy intervention.
Could I just?
Christina,
yes.
Oh, go ahead.
I wonder if it's a very quick one, just to characterize. So this is dynamic inefficiency induced by an enormous amount of precautionary savings by people. Is that where I put the problem?
Yes, so we're going to consider scenarios where there's overaccumulation of capital, and you can think of that as sort of dynamic inefficient region. But we're also going to be in cases where there is not overaccumulation of capital. Capital is actually restricted because of the markups. But there is the description of what you're saying, where the precautionary savings is what gives rise to negative interest rates. So that's true, exactly what, in line with what you were saying. Somebody else had a question?
Yeah, Christina.
Yeah.
Sorry, just one quick clarification. The markup wedge can exist for two different reasons. One is monopoly power, the other is some type of financial friction.
Yes.
And they can kind of look similar as a wedge.
Yes.
But in one case, the firms want to expand the production, but they cannot. In the other case, they actually do not want to expand the production. And it might require different types of tools to address.
Yes, so that's a good point. I think that we have thought about a different interpretation of this markup, but in some of our policy proposals, we are going to expand that capital. So those would have to modify it if our interpretation is different. Now we will have one where we don't change any capital, and so perhaps that is more robust to those details of where the markup is coming from. Any other question?
Yeah, are your policies going to be time consistent?
Yes, so we will be thinking about, this is a perfect foresight model, and we're not going to be we're going to be checking, is that going to be a sufficient condition for the feasibility of operator improvement? And this is not going to be sort of a government optimizing over, in stark contrast, sort of maximizing the welfare of the representative consumer or anything like that. I'm going to show you, we're going to try different plans and show you that, those, what the resulting implications are for the different fiscal plans. So completely commitment on the fiscal policy plans that we consider. Okay, so it's useful actually to evaluate these robust priority improvements to split the problem into two parts. The first is going to use sort of a household optimization module, if you will, to obtain a mapping between the resulting changes in interest rate and transfers from the policy and how that maps into an aggregate savings function. And the second step uses the primal approach to combine firm optimization and government budget into this single feasibility condition. So, for the first step, let me define this curly A as the aggregate savings plan, aggregate household savings that results from the fiscal plan. And these are going to depend on the sort of sequences of interest rates and transfers that such fiscal plan delivers, okay? And we're going to define a sequence of interest rate transfers, debt, and capital as admissible if for all time periods, the sequence of interest rate and transfers is consistent with the aggregate household savings and asset market clearing, such that the households say aggregate savings equals debt and capital. And an admissible sequence is going to ensure that sort of policies and prices are consistent with household behavior and also consistent with asset market clearing. And then we have a result that sort of if an admissible sequence of interest rate transfers, debt, and capital is such that the interest rates and transfers in the sequence are greater than the laissez-faire levels, and this fiscal feasibility condition holds, then this sequence constitutes a robust Pareto improvement. And so next, I'm going to develop sort of what why these how this fiscal feasibility condition arises. Okay, so think about a particular sequence of capital that is part of this admissible sequence that are being considered as sort of to be implemented with the fiscal policy plan. Given that capital in the admissible sequence, then the labor taxes and profit taxes are such that it ensures that it delivers households stable wages and profits. And because we have labor supply without wealth effects, that also ensures that the labor supply, the aggregate labor, is going to be equal to the laissez-faire level. Next, we show that the tax revenue from this class of policies, the revenue that comes from labor, capital, and profits, is going to be equal to the difference in output relative to payments of capital minus the same difference in the laissez-faire economy. And to give you a sense why this is true, think about the total output here at any point in time is going to be equal to the labor income, profit income, payments to capital, and the tax revenue. And so, the tax revenue then is going to be equal to the difference between output minus the payments to capital minus, these payments to wages and profits. But this payments to wages and profits in the laissez-faire is exactly the difference between these two objects. And so our feasibility condition says that a robust Pareto improvement is feasible if this tax revenue is greater than the cost, which consists of sort of the debt, paying the debt, and paying the transfer. And what I want you to focus on with this feasibility condition here is that the heterogeneity and the feasibility of robust Pareto improvements are going to matter only, the heterogeneity is going to matter only to the extent that it affects aggregate capital and the level of interest rates. So at this point, what you could do is start to try policies out and see which type of policies are going to give rise to that are going to satisfy this sufficient condition, okay? But I'm going to give you, a couple of examples that we think are useful. So one policy that we find useful is one where the capital is unchanged. And so there's a constant K policy, but the government, issues more debt. And so what happens is that when the government issues more debt, the interest rate is going to rise because it's going to induce households to save and absorb this extra level of debt, okay? With higher interest rates, that is going to tend to decrease the demand for capital. And but under a constant K policy, then the government is going to subsidize capital to maintain the level of capital at the laissez-faire. And this is going to be, the subsidy to capital is going to be the part of the fiscal cost of the government, okay? And that is going to be exactly equal to the difference in interest rates in the new equilibrium minus the laissez-faire interest rates times the initial level of the capital stock. And so you see here that sort of under this policy, the sufficient condition becomes much simpler. A robust Pareto improvement is feasible if the revenue of the government from these net issuances is going to be greater than these fiscal costs, which is just sort of the initial level of capital times the difference in interest rates plus transfers. This sufficient condition has to hold in every single period, okay? And but we find that in the examples, it tends to be more binding, in the new steady state, because this is when the revenue from new issuances has stopped. So let me give you sort of build up more on that sufficient condition in the new stationary equilibrium with fiscal policy. So this says that sort of the revenue that the government gets from the debt, this is with negative interest rates, this is like the seniors revenue, has to be bigger than this payment, this sort of the capital subsidy. Okay. So let me walk you through this condition in the context of a Iagari graph. So what I have here in the x-axis is the total savings, and the y-axis is the interest rate. And this black line is the aggregate savings function, which is sort of increasing in the level of the interest rate. We're starting with a scenario where the total savings is going to be equal to the capital stock, okay? And so this red line here is the marginal product of capital over the markup, okay? And we're moving to a situation with fiscal policy where the total savings of households do not have to be equal to the capital stock, because they're going to be equal to the capital stock plus the level of debt. And so you see that, in the level of debt here is the sort of this horizontal distance in the gray rectangle, and the interest rate is the vertical distance on this gray rectangle. Okay, so sort of this left-hand side of the sufficient condition is precisely the area of this gray rectangle. Now, what is the cost of the policy? The cost of the policy is the change in interest rates times the level of the initial capital stock. That is the red rectangle here. And so a robust priority improvement with the constant K policy is feasible if the gray rectangle is higher than the red rectangle, okay? And you see that this feasibility is going to be, this condition is going to be easier to satisfy if the aggregate savings function is very elastic. So if this line here is very flat.
Christina,
basically,
Christina,
yes.
This picture, I thought in this picture, you're only comparing across those steady states.
Yes.
For
yes.
a robust Pareto improvement, don't you have to worry about the entire transition?
Yes, completely. And we will show you, this is,
you just
it turns out that the harder with the constant K policy, the harder condition to satisfy.
Sure.
This is the sufficient condition, and it has to hold for all T. In the earlier periods, you have the issuance, you have the revenue from the debt issuances. So it tends to be more binding in the steady state. But you're completely right that the condition has to hold for every point in time. But basically, the robust priority improvement is going to be feasible if the government can increase the debt with a small change in R. So consider an example where, in fact, a robust priority improvement is feasible, okay, of this sort with constant K. Everybody feels that their budget sets have expanded, okay, but the aggregate capital is constant, aggregate labor is constant, aggregate consumption is constant, okay. So how is that possible? Well, this policy makes everybody feel richer, and it improves their allocation because it improves on risk sharing. Okay, the rich, find it optimal to save more at the higher interest rate. The poor can consume a little more because of the transfers. Okay, and so these the issuances inducing better risk sharing is a result sort of similar to a Samuelson OLG result, but in the Bewley, Haggett, and Iagari model. We like this policy because it's very robust. We don't need to know the details about the micro heterogeneity. We don't need to know production elasticities, and we don't need to know whether there is overaccumulation of capital or not.
Christina, you have 5 minutes.
Yes. Okay, so with more information, we can do better, or we can think about other policies. So quickly here, if there is overaccumulation of capital, we find that a robust priority improvement always exists. And the way to achieve one is one where sort of the government taxes capital and issues debt, but keeps interest rates stable. And that is actually one that is going to ensure that there is enough fiscal resources to compensate for the reduction in wages that sort of crowding out capital would entail. We also consider a case sort of when there is not overaccumulation of capital and when the government might want to crowd in capital. And that might be useful because capital is depressed due to the markup, okay? So, you know, it could be useful, but the question is whether it's a robust priority improvement, okay? And so I'm gonna show you in the simulations sort of these paths, but let me say that these type of policies are going to imply that the government is going to have to have fiscal costs associated with this capital expansion, capital crowd in. And so suppose that the government does it without any debt. Then the fiscal cost and whether or not this is a robust priority improvement, it's sort of a race between how fast capital increases versus how fast this cost of higher interest rates is going to arise. And this type of cost is going to be more binding early in the transition before the capital buildup, okay? So let me show you a bit more on this with some simulations. So we're going to calibrate this model to basically assess the scope of these robust priority improvements and also to give you a sense of the welfare numbers. We're going to, I guess, importantly, think about, as John was asking earlier, we're going to think about calibrating this economy so that the interest rate on average is equal to negative 1.4%. We're going to have markups of about 40%, and we're going to take very seriously the idiosyncratic risk from income risk by using the estimates from Kruger, Midman, and Perry's using US data. Okay, so a few plots and I'll conclude. So these are the transitions of, so what happens when the economy starts with a laissez-faire environment and it increases debt to 60% while keeping capital constant. This is the constant K policy. We find that this is a robust priority improvement. And it is because sort of interest rates are going to be higher in the new equilibrium relative to the laissez-faire. In fact, they overshoot. And transfers are positive, are much higher early in the transition, but positive throughout, okay? And the minimum welfare gain, the welfare gain is going to depend, is going to be different for different people in the distribution, but the minimum welfare gain is 2.1%. And the source of the welfare gains is this better risk sharing. So the variance of consumption, the dispersion of consumption is reduced quite a bit on impact, but also in the new stationary distribution with policy. Now let's consider a case of capital crowding in. So this is a case where we're going to have debt as in the base, as in the constant K policy, but then capital increasing to the golden rule. And we find that this policy is also a robust priority improvement because, again, interest rates are higher and transfers are all positive. And again, the welfare gains are going to be on the order of 4.5%. So they're larger, and they arise because there's improvements in risk sharing, but also there's more resources for consumption later in the transition. Now, to think about, so this is a robust priority improvement where we expanded debt and capital. Next, I'm going to show you one where what would happen if the government wants to induce only increasing capital to the golden rule, but does it without any debt, okay? So these type of policies are not robust priority improvements because they require taxation. And you see here on this plot that it requires taxes early in the transition to finance this expansion of debt, despite the fact that in the new stationary distribution, there will be enough funds after the capital buildup to have positive transfers. So what this says, if you compare this with the previous result, is that sort of the role of debt to smooth transfers is going to allow for, is going to make it more feasible for robust priority improvements that policies that crowd in capital. And in this sense, debt and increases in capital are going to be complements because they help smooth these early fiscal costs. So let me conclude. So we've provided simple conditions for robust priority improvements. The key is a relatively elastic aggregate demand for savings that gives rise to low interest rates, both in the short run and the long run. Government debt is helpful for risk sharing and for capital expansions. And the two roles that it plays is a seniorage revenue role and a transfer smoothing role. In terms of taking our results sort of for applications, of course, there are many caveats. We have an environment without shocks, but in reality, you could think of risks of rates increasing that could potentially hamper the applicability of these robust priority improvements. And we are thinking that would be useful to assess more in detail sort of the distortions and indebtedness of actual economies. Thank you.
Great, that was very good and right on time. Our discussant is Mark Haggett.
Very good. Thank you for the invitation. Let's see. The authors basically do two things. They provide this proposition one, sufficient conditions for improving policy with simple instruments, where they state the proposition in terms of kind of counterfactual equilibrium sequences. And then they try to argue about the quantitative relevance of these counterfactual sequences. The model framework they consider is a generalization of the framework that Rao and I wrote about. So I guess mostly I'm going to view what I have to say is about a little exposition of their proposition one and a little discussion of relevance. This slide will be a little bit busy, but it will have in one slide basically the logic of their proposition one. So what I'll do is I'll say, consider the most stripped down version of their framework, which is one without a labor leisure choice, the one without any markups. So what we know is that in a stationary equilibrium of that model, we know you always get a relatively low interest rate and you always get a relatively high capital stock. So there's aggregate precautionary savings. The premise of their proposition one, at least in this stripped down basic model, is that we start in a stationary equilibrium where government is basically not doing anything, okay? And then you consider a policy where the government then borrows. So it has some positive borrowing and it uses that to make a lump sum transfer. This would be a particular example of their proposition one. So you give a positive transfer to each person, but the government also pursues other policies to, for example, keep the capital stock constant at its initial stationary equilibrium level with capital subsidies. Then their logic is very simple. If you can construct an alternative equilibrium where the interest rate remains always as high as the original real interest rate, and you always give non-negative transfers, then each agent's consumption plan in the original stationary equilibrium is still feasible, right? The real wage hasn't changed in this particular thing. And so each agent will be actually strictly better off, right? They could choose what they were choosing before, but now they have other things they can choose. The only other things that they need to talk about are the government budget constraint holding and asset market equilibrium holding. But the government budget constraint holding, the way to interpret it is kind of the right-hand side is measure of the capital subsidy needed to keep the capital stock constant over time. And the left-hand side is just the seniorage revenue the government can generate. So if the government can generate the seniorage revenue needed to pay these capital subsidies, then the government can finance this without having the debt explode. Of course, there's an asset market equilibrium condition that needs to hold. The assets that agents hold at time t should equal the debt and the capital stock. Okay, and so just combining all of these conditions, their proposition 1 says is you can find a counterfactual sequence RT, which is at least as large as R, non-negative transfers in the government budget constraint holds without the debt exploding, then you have found this Pareto improvement. And there is the stripped down version of the result. And they state that this is a robust Pareto improvement because this would hold if the original stationary equilibrium had kind of like agents differing in groups that had arbitrary discount factor, utility function, or Markov process on their labor endowment. So that's in essence the robust part. Okay. They have a claim 1 and claim 3, excuse me, in their paper that says if the original interest rate was strictly positive, then the sufficient conditions they highlight cannot hold. And the logic there is very simple. If the real interest rate were positive, then there would be a snowball effect. In particular, you could go up and realize that the equilibrium they're constructing, the right-hand side here is positive, at least in the simplest case. And the only way that this condition can hold, given that the real interest rate is positive, is if the debt is being turned over, or at least turned over. And that's something rolled over. That's something that they don't allow. So if you had a look at their proposition 1 for the stripped down model, you'd say that's not really a strong case for a Pareto improvement to exist. But what they go on to show is that they have a generalized version of proposition 1, and that holds in models that allow borrowing, allow endogenous labor, allow markups, even allow technological growth. They kind of have a more elaborate class of economies for which this holds. So then I guess the remaining issue in the paper is how relevant is this? And so what they're going to do is they're going to calibrate a model which is more elaborate than the benchmark model I described. They're going to add endogenous labor, markups, and some hand-to-mouth agents that collect the profits that result from these markups. And they'll construct a number of ways of basically increasing debt and pursuing various tax policies that either keep the capital stock constant or they have other policies. Their calibrated model does have an R less than G condition, which Christine explained that was motivated by short-term government debt being smaller on average over some periods than the growth rate of the economy. And in their particular calibration, they have an initial steady state where the capital stock is below the golden rule. Okay, so their calibrated model has a low interest rate, but below the golden rule. And she showed a number of possible policies that will keep transfers positive, the green line, increase real interest rates and keep wage rates at least as large. So those are the sufficient conditions on counterfactual policies. And so they have a numerical example motivating the relevance of those policies. I'll say maybe a couple other things. First, they do impose a version of R less than G, which comes up in many literatures. And I think maybe other people will remark on that, but I'm not going to enter that minefield right now. But I will say something about markup. So the markups in this framework, I would use words like grafted onto an otherwise competitive framework as being the description. The technology, if you wanted to imagine many firms, everyone has the same technology, constant returns to scale. So there's not really a natural market power in this particular model. And so it seems that the way that I view markups in this model is kind of like a way of having R less than G, which is important for the result, but yet they're kind of like below the golden rule. And when they examine alternative policies, none of those alternative policies end up changing the markup rule. The markup rule is not in a way like micro-founded within their model. So it's kind of like an open issue for me about how to think about markups in this framework. The last thing I'll mention is that there are other literatures that start off with a similar premise that you want to think about optimal taxation in departing from a steady state, stationary equilibrium with idiosyncratic risk. For example, there is a recent paper by Chang and Park, which think about choosing different fiscal instruments. They think about choosing the entire income tax schedule on labor income optimally in like a utilitarian sense, or that talk about idiosyncratic risk and markups and think about choosing other fiscal instruments to address markups. And so I guess a natural issue eventually, maybe 10 or 20 years down the line, when kind of a new version of the Mearley's report is written, is kind of how to think about their simple fiscal instruments versus, these to some people may seem more natural instruments, optimal income tax schedule. And so, kind of like ask what is their kind of view on the state of the literature and how policy advice might, what is a holistic view of policy advice, several years down the line. Thank you.
Okay, if anyone has questions, please raise your hands. Christina, in the meantime, would you like to reply a little bit?
Yeah, so thank you very much, Mark, for your discussion. I want to go back to one result you said that with positive interest rates, there will not be a room for robust period improvement. And so a couple of things. So first, so this is only under the case where there's no markups. So markups are zero, and you pointed that out, but I just wanted to emphasize it. And I think that that result, and is exactly what you said, the debt is going to snowball. But that result also emphasizes the differences between our paper and, for example, the paper by Aggregate and McGrath. Okay, so the type of increases in welfare that they find really are in nature different than the ones that we construct. So I just wanted to point that out. But also, with markups, with the positive interest rates, there is room for robust priority improvements. We have, for example, an example in the neoclassical model that markups gives this additional avenue that the government can use to generate robust priority improvements. This is what I wanted to say. I don't know if Manuel or Mark are online.
Thank you, Christina. I think that's right.
Good. Patrick? Oh.
I'm here. Shannon, can you let me turn on my video? This is just reflecting back 30 years ago as opposed to 40. I was thinking when I was in the 90s, the big deal was endogenous growth theory and the growth regressions. And in the key theme in all of that across countries is we need policies to increase capital. We want to drive down the marginal product to capital, because in all the poor countries, the whole problem is there's not enough savings. And now we're in this new regime where we're talking mostly about risk sharing. And I was just thinking, if you had to think of a more general, this is going outside your paper, of course, across country, across time, is it that we need, we have too much savings, so that's why interest rates are too low, and that's the bad thing, we got to worry about improving risk sharing? Or is the first order thing increasing capital and getting a GDP up, like in the 90s we used to think was the big deal? So that's well outside your paper, but it's just reflecting back on how literatures have changed over time.
No, so if I could say, so we, we do have something to say about increasing capital. We have a sort of distinct role of robust priority improvements, which is precisely that markups are depressing capital, and the government can, design policies to increase it. And I guess the extra wrinkle that we provide with regards to that question is that government debt under low interest rates actually allows for the possibility, sort of complements the possibility of increasing capital. So sort of we're focusing on these two distinct roles. One is the risk sharing, as you mentioned, but the other one is this sort of the fact that the government debt and low interest rates allows for this transfers moving role of debt that precisely could increase capital.
Juanpa, would you like to go ahead?
Yeah, sure. I'm going from the big picture question of Patrick to the nerdiest I can think of. I'm going to go back to the number of instruments that you have there. So, so you're having these policies that they're part of improving, but then you're also making in the proof. You're also looking at the restricted set of those in which the wage doesn't change and profits do not change. So if you think in terms of policies, you need more instruments because you want to think of keeping those two constant. I understand you need that for the proof, but one question is whether you actually need them, and the second is, it seems to me that then you're basically choosing the labor income tax to make sure that the wage is going to be constant. But then if that is going to be set different from zero, I didn't see it on the budget constraint when you were doing your sufficient conditions. So there I got lost. Can you clarify that?
I mean, maybe I just say a few things. So it depends on the number of instruments that we end up using is going to depend a little bit on the policy. So for example, in the constant K policy, the instruments that we use are the subsidy to capital and then government debt and transfers, but nothing else. Nothing else is needed at that point. Now, in the other ones, in the ones that expand the capital, then you need multiple instruments because of the need to make sure that the profits and the wages don't fall, and you want to do something else with the capital tax to change the capital. So it's we allow all of them to be used in prior, but then when we go through the different examples, different instruments are used. Not sure if
got it. Thanks.
Fabrizio.
Yes. Yes. Very nice paper, Cristina. My question is: so you work in a framework which the only inefficiency is the lack of risk sharing, right? So that's the incomplete market. So if you want to have priority improving policy, they have to be improving the risk sharing, and that's sort of the big point I think make the bill by Per, Victor.
I mean, we do have the markups, right? So
yeah, forget about them. That's sort of like I see as sort of a side issue, right? Forget about a markup, just think about risk sharing, right? Or I don't know. I don't think a paper is about markup, right? It's because you focus on this, or is it?
Well, I mean, the thing is that suppose that we don't have markups, okay, then there is a way to increase consumption because with negative interest rates, there's overaccumulation of capital. And what you want to do is actually, issue debt, crowd out capital, and that is going to move capital towards the golden rule from the right, and it's going to increase. So it's not only about risk sharing. Risk sharing, of course, is a big part of it, and incomplete markets is crucial for being able to talk about negative interest rates. So in a sense, yes, but I think that there are these two different sources of.
So my question is related to that. So say, okay, in the standard model you work in, the standard, the only reason to get a lot of saving is precautionary saving, right? Mm-hmm. People care about risk, but we know that this model fails very badly in replicating the wealth distribution. In particular, you don't have a lot of rich people. So I was wondering, have you thought about putting, for example, some sort of this heterogeneity in discount factor or in endowment so that actually the rich who save a lot? And so the reason why there's an interest rate, this very low interest rate, is because there's a lot of people with high wealth and very high, they want to save a lot. Would you still get these things if you change the reason for interest rate? So in the sense, maybe the elasticity of the saving supply is not going to be so high, so you might be in territory which is harder to get this spread improvement.
Yeah, I mean, we totally, I mean, our approach precisely does not rely on the details of the micro, why the different people, and we allow for differences in preferences in the theoretical part. When we go to the application, it's true, we, think about more parsimonious calibration, but we could definitely look into expanding that.
Thank you.
So
Manuela and Mark, you should feel free.
Yeah, let me just say something to Fabricio. We allow for potentially differences in household preferences. But at the end of the day, the message is that what matters for our results is the aggregate savings as a function of interest rates and transfers. And if you know that, then we don't really need to know the details that broke that function about.
Right. So if you have a lot of saving coming from, say, the rich because they want to save a lot, I would expect the elasticity would be fairly low in that case, right? Or maybe.
No, it's elasticity is level versus changes. I'm not sure.
Yeah, I don't know. I was just thinking, yeah, maybe you're right.
I mean, we do need a high beta. I mean, just to get the interest rate to be what it is in the data. So, I mean, it's pretty. Just let me just say one more thing about, because Fabrizio and Mark raised these things. I mean, just kind of about the conceptually what we're trying to do. It is kind of, let's just ignore the markup for a second and say we want to improve risk sharing, but we're kind of tying our hands both in terms of the instruments and kind of what the government knows. It never, we never take something from somebody and give it back to somebody, give it back to them later, right? There's no, diamond Social Security where we take when you're young and give it back to you when you're old. There's no progressive taxation where I'm taking from the rich and giving to the poor. So we're really thinking about just making everybody feel like they're better off. So it's a much different exercise than, even than Gary McGrattan or what Victor and co-authors did with their constrained efficiency. We can't manipulate relative factor prices to make one group better and one group worse, right? That's kind of what we're interested in. And it seems like an insanely high bar, but hopefully we've convinced you that it's not. At least in our model, right?
Chari?
Couple of observations. One is, I'm sorry, can you hear me? Hello?
Yes, we can.
Okay, sorry. So one is about the markup. I think the markups, I understand why you're doing it, but it's still a distraction. Part of the reason why it's a distraction is if you did the most obvious thing, which is to write down a differentiated products model, which naturally generates a markup, we know all the instruments, the usual instruments of either output subsidies or input subsidies that are going to correct the markup. So the natural benchmark to doing all this is to allow for enough instruments to eliminate the markup. I know why you're doing it, but it still seems like a distraction. But let me turn to the more substantive stuff that's lying all under all the, I think many of the questions that you guys have heard today. I think from a theoretical perspective, this is a totally cool paper. And I think I love it. And I think a lot of people do. The separate question, which is how useful is this paper as a way of thinking about the afflictions of, let's say, developed economies over the last 20, 30 years. There, I think the central question, which a deterministic model cannot account for, is that we've seen a long period of time where ex post returns and ex ante yields on government debt, like instruments, have been below growth rates. And at the same time, it's hard to measure ex ante returns on say, the stock market or capital market more generally, but we can measure ex post returns from the national income accounts. In every single country over this whole time period, it's easy to look at the numbers from national income accounts. Ex post returns on capital have well exceeded growth rates and are not noticeably different from what they used to be in the preceding 30 years. So what is the R in your model? Should I think about that R as a return on capital? Should I think of it as a return on debt? In a deterministic model, a sensible deterministic model, those two returns have got to be equated. But it seems to me that the central feature of the data is that those things, in an ex post sense, have been different for a very long period of time. So my guess is that if we want to grapple with this issue about do developed economies have too much capital for their own good, we really have to think about models with uncertainty so that we can meaningfully talk about differences between those. I'm not so sure that from the perspective of those kinds of models, there is definitive evidence that we have too much capital sloshing around developed economies or the world.
Yeah, well, so maybe I'll answer a little bit. So, I mean, I think that we definitely, view shocks and uncertainty and the possibility, especially the possibility of increasing future interest rates, as a very important question to consider before suggesting this type of policies for actual policymakers. So I think we're totally on board. But I think that we find actually surprisingly for us as well, sort of this possibility of robust priority improvements in a model that we all use. And so we found some interesting stuff as a first step, even abstracting from the aggregate shock question, which certainly we think is important. Now, it is not true that in our model there's too much capital. There could be cases where capital is actually quite low because of this markup. So that would be it's not a characterization of what we find. But I agree that as a next step, thinking about aggregate uncertainty in this and how that would shape and how it would change things, that is certainly an important question. Mark or Emmanuel? No, Mark, you can't hear you.
All right, so the reason we like the constant K policy is it doesn't have to take a stand at all on whether there's too much or too little capital. And this goes back to what Fabrice was saying. That one is really about risk sharing. We don't really have to take a stand. There's obvious reasons why we don't have risk premium in there, because we'd have to figure out, what the government is doing to them. And that's not really kind of the focus of what we're about, right? But in some sense, we're not taking the position that the US has overaccumulated capital or underaccumulated in that first one. And to be honest, the data suggests it hasn't overaccumulated if you look at the usual kind of money in, money out kind of metrics.
John?
So I want to pick up where Charlie left off. So the return on capital is like 10%. And let's go back to Henning Bohn's classic 1995. It is entirely, if you have an economy with risk, and in his case, precautionary savings, the rate of return on government debt can indicate dynamic inefficiency in present values that don't converge, even when the correct present values do converge and you don't have dynamic efficiency. So that's not a minor extension. That's crucial to the calibration and which side of the curve we're on. I'll also complain a little bit, a model that's centrally about transfers and ensuring idiosyncratic risk really needs to recognize we have a strong social means-tested social safety net that is about transferring risk. But the big question I want to ask, you kind of deferred it, and I don't think we get to defer it. Your model is one where there's no primary surplus and no debt. There's a one-time fiscal expansion to fund transfers, and then we maybe go away at R minus G. The US economy has 100% debt to GDP ratio. Primary surpluses are 5% of GDP. So your R minus G of 1.5% is going to leave 3.5% of exploding debt. And then the entitlements come. And then once every decade, we have what Neil called a once in a century shock. It turns out to be once a decade where we rack up 25% of GDP. So Blanchard started this, but this scenario of zero primary surpluses, one-time fiscal expansion, go back to zero primary surpluses and R minus G way out of it, seems to have nothing to do with the US fiscal situation. And I don't think we can ignore it. That's what we're here about. That's the policy issue of the day. Can we finance a one-time fiscal expansion and get out of it painlessly? And you will be cited for saying, yes, we can. And if that's not what you want your model to say, you better be careful about it.
I mean, let me take a little bit the answer. So we actually have, in the context of our own model, a Laffer curve on how much you can get from this type of fiscal expansions. And there are very large levels of debt above 200% of GDP where this is no longer, there's no feasibility for robust forward improvements, especially with the type of policies of the constant K policy, which is what we focus on for the risk sharing piece. So even and I didn't have time to flesh that out, but the idea is that the more and more debt the government has, the higher and higher interest rates, up to a point where the fiscal cost of making sure everybody does not, for example, wages don't decrease, is no longer feasible because interest rates are too high. So we do have, in the context of our model, that force. Maybe we could, and we talk about it. It's just it's sort of at very high levels. Now in the US, they're not that high anymore because we're already at 120% of GDP. So maybe we can flesh that more. But
it's about structural primary deficits of 5% of GDP. So I don't care where you start with debt. If you start with a structural primary deficit of 5% of GDP, I think we're toast here. And that's the fiscal issue for the United States.
Let me add a little bit to this, John.
Please.
So we propose conditions for a Pareto optimal allocation to emerge. And we show you they depend a lot on, yes, initial conditions where you start, and the change, the elasticity of savings to, or the interest rates to, total savings or government bonds. We can bicker about these things, and probably if you change these parameters, the conditions will probably change, and you will get a different outcome where the policies may not be. There may not be an RPI in the way we did it. So you have the structure. I mean, I'm not sure if you complain that we're missing something or that we're starting from the wrong place. I think the second one is that, yeah, we can recalibrate things and see whether that, the conditions hold. But yeah, we haven't, we have the apparatus to do it.
Jim Bullard.
Thanks, Marco. I love this paper. I thought it was really good, very interesting. Some of you know that I've been working on OLG type versions of similar ideas, monetary policy mostly about providing complete markets, and you can get the Pareto improvements that are described in this paper, even in the world with aggregate shocks, if you run the right monetary policy that offsets those shocks in just the right way, and you're going to get right to the golden rule, and that's what those Massa's papers are about. So I actually think this might be the future of monetary policy, because I don't think, and probably this crowd probably doesn't think, that the sticky price rationale has been that useful. Has made some predictions during the low interest rate era that probably aren't the ones that we want to make. On the R less than G, I think Chari has it exactly right. You're observing a world in which the returns to capital seem clearly higher than G, but the returns to debt seem clearly less. And it seems to me that it has something to do with especially for the US or other really big countries that have a lot of policy credibility, it has something to do with the moneyness nature of the government debt. So it's maybe not paper currency the way we have it in a lot of monetary theory, but it's interest-bearing currency, if you want to think about it that way. And this is very valuable in a global environment, and might be even under-issued in a global environment. So that's the way to get the notion that the returns to the debt are going to be less than the growth rate, but the returns to the capital are going to be higher, and there might be further Pareto improvements from that point. So I think we're going to have to confront this. I think to ignore that fact is probably not the way to go forward.
Any of the authors has comments?
Yeah, no, thanks, Jim. So I think we have to a little bit about introducing uncertainty into the model so we can respond to both your comment about risk premium and Chari's initial comment. But we are not there yet. I mean, it's something that we know is important, and give you a measure of how much time you have before the economy switches so that the interest rate may change. For example, that's another concern that we also had, and we need to think about incorporating that probably in a different work. I think about these issues, but we haven't yet done it.
So there's one question for the audience from the audience, and it's related to the idea of solving the markup problem. So in the current, I'm going to add a little bit of my own to that question. So in the current version, it's useful under some conditions to increase debt because, say, if you're crowding in capital, you can go back and tax the returns of that capital or subsidize that capital so that you're going to adjust the budget appropriately. But you're not allowing the same with the monopoly profits arising from the markup. What if you could actually tax or subsidize those profits, or maybe tax the profits away and subsidize output? How would that change those conditions?
So let me take that question. So we precisely do not want to, as part of the robust period improvement, maybe you might want to do a different metric, but for us, we do as part of the robust period, we cannot reduce those profits. Okay, so yes, we have the instrument, we have those instruments in terms of the profit tax. That's one of our instruments. But there might be some people that their income relies a lot on profit income. And if we would tax that profit, that would hurt those particular set of people. So we have that instrument, but this general idea or general point that with sufficient instruments you can remove the distortion and remove those profits. That is not basically the game we're playing.
Excellent. So that was a great morning. Thank you. We'll reconvene at 1:10 Minneapolis time, and Fernando Martin will be in charge. So I get to enjoy the rest of the talks more. I enjoyed them here too. See you later.
Okay, welcome back everyone to, I guess, the afternoon session of this conference. And first up, we have Hanno. And if you want to share your slides, we can start.
Thanks, Fernando. First, let me start by thanking the organizers for putting together this conference in honor of Tom and Neil's work. As I was preparing for this talk this morning, I realized that all four of us are actually direct descendants of Tom in the academic sense, and we'll try not to embarrass him. The title of the paper is the U.S. public debt valuation puzzle. And the question on the table is, what's the fiscal capacity of the US? And the discussion we had after Christina's presentation is actually a great segue into what we're going to do. So there's sort of two ways of thinking about this. You can use models that don't have priced aggregate risk. And in those models, people have argued, well, if the risk-free rate is lower than the growth rate of the economy, then perhaps there is no real fiscal cost to running deficits, because essentially the US government could just keep rolling over its debt as long as the risk-free rate is lower than the growth rate of the economy. But being asset pricers, we're used to thinking about models where there is priced G risk, where G is the growth rate of the economy. And in an economy where that sort of risk is priced, we're going to show that the government's ability to make risk-free promises is actually severely limited. And G is going to turn out to be risky in this setting, even if on average the risk-free rate is lower than the growth rate of the economy. So what we're going to do is we're going to simply do a valuation exercise. We're going to try and price the entire government bond portfolio, not just individual bonds, which is what we usually do in asset pricing. But we're also going to insist on pricing other assets. So we're going to address what we were talking about before, the spread between the return on risky assets and the return on safe assets. And basically, we're going to conclude that the risk-free yield curve is not the right discount rate for valuing the entire government bond portfolio, and this has important implications. Okay. So, sorry, we're going to revisit this question by bringing in considerations of risk to show that government debt is backed by current and future primary surpluses. So the way you do this, as most of you know, is you start from the static one-period government budget constraint. On the left-hand side, you have government spending. On the right-hand side, you have tax revenue, denoted by T. And you have new bonds that are issued by the Treasury, QT, at a price PTH. We're going to work with zero coupon bonds here to make our lives a little bit easier and to make the notation a little bit easier. QT -1 are the bonds that had been issued in the previous period. What we're going to do then is iterate forward on this government budget constraint, imposing a no arbitrage condition. So basically, you're imposing that the price of a 10-year zero coupon bond today has to be the properly discounted value of the price of a 9-year zero coupon bond at the end of next year. If you keep iterating forward and you impose these no arbitrage restrictions, you end up with the valuation equation that most of you are familiar with, which says that the value, and these are market values, going back to Tom's talk from this morning, we're talking here about the market value of all treasuries, has to be equal to the properly discounted value of future primary surpluses, plus this, what I'll call a nuisance term, which is the value of debt outstanding in the distant future, discounted back to today. And in a world with aggregate risk, that last term will actually go to zero as you push it out farther into the future, even when the risk-free rate is smaller than the growth rate of the economy, because there is a risk premium lurking in the background. And I'll come back to this later. So assuming that that term drops out, then basically what we're left with is the equation that's familiar to most of you. The market value of government debt has to be equal to the expected risk-adjusted present discounted value of future primary surpluses. This equation holds ex ante, both in real and nominal terms. You could think of M as being the nominal pricing kernel, or stochastic discount factor, and T and G could be nominal values, but it also holds in real terms. And a version of this even holds if we were to allow for sovereign default risk. Importantly, this derivation doesn't rely on market completeness, it just relies on no arbitrage restrictions. So what I want to do next is sort of explore what we can learn from an asset pricing perspective to this equation. So basically, what you have on the right-hand side, that cash flow, these surpluses, primary surpluses, those are the cash flows that an investor who buys all government debt that is issued will receive in his or her portfolio. And if you look at these primary surpluses for the US federal government, plotted in this graph, what you realize is those are extremely cyclical. They're extremely pro-cyclical. The gray shaded areas are NBR recessions. And what you see, not surprisingly, is that surpluses go down. The surplus here is the difference between these two lines. The blue line is tax over GDP. The dotted line is spending over GDP. So in terms of business cycle risk, the cash flows that accrue to stand-in bond market investor who buys all of the issuances has sort of wrong way business cycle risk. That's an important thing to be aware of. But in addition, and this is something Tom alluded to earlier as well, we think that these surpluses are going to be sort of co-integrated with GDP or output. That is to say, in the long run, the ratio of these surpluses to GDP ought to be stationary, which means that surpluses are also going to expose to long-run output risk. What does this imply? Well, to explore the implications of this, let's take a look at the Treasury's balance sheet. And what we're going to do here is sort of standard Miller-Modigliani type analysis that we would apply to a corporate balance sheet. But instead of looking at a corporation, we're going to look at the Treasury, where on the left-hand side, you have tax revenue. PT denotes the market value of that claim to future tax revenue. On the right-hand side, you have PTG, which denotes the value of a claim to government spending. And then, of course, you have the residual term, which is the market value of all treasuries, denoted by B. Okay. Now, basically, we're going to argue that the Secretary of the Treasury can't do anything that a CFO can't do. So financial engineering here is not going to create any value. The risk on the left-hand side has to show up on the right-hand side as well. And I've tried to show you in that graph before that there's a lot of tax revenue risk, right? Taxes are extremely pro-cyclical and they're co-integrated with GDP. And so that risk is going to have to show up somewhere, either in spending or in debts. And in US data, it doesn't seem to show up in spending because if anything, spending is quite safe. Spending is counter-cyclical as a fraction of GDP. What does that imply? Well, we can back out an equation for the risk premium that a bond investor would require on holding a portfolio of all US treasuries. And that risk premium is going to be determined by the risk premium on a claim to taxes and a risk premium on a claim to spending. You're long in a claim to taxes if you're a bond investor, and you're short in a claim to spending. But the long position is larger, of course, than the short position. And so what that means is that there's implicitly sort of a trade-off between insuring bondholders and taxpayers. By the way, you could rewrite this risk premium equation just in terms of betas. So beta here would be the covariance between the pricing kernel and the return. You can pick your favorite asset pricing model. It could be the capital asset pricing model, could be the consumption CAPM, and this equation would apply. What this says is the following: if the Treasury wants to manufacture risk-free debt, then actually that implies that its tax process has to be less risky than its spending process, which would obviously imply that taxes would look very different from what we see in the data. So if you're going to insist on risk-free debt, that puts a tight restriction on the types of tax processes that one would expect to observe. Our analysis in US data, which I'll show you in a second, is going to indicate, in fact, that taxes are riskier than spending. And so the risk premium on the tax claim would exceed the risk premium on spending. Now let's think about what that implies for a second. Let's go back to that equation for the risk premium on a portfolio of all treasuries. If I now impose that the risk premium on taxes exceeds the risk premium on spending, that immediately implies that the expected return on all treasuries has to be larger than the expected excess return on a claim to taxes. So that's going to imply that actually the debt is quite risky.
Hanno, can I ask you a trivial question? This is Patrick.
Yes.
Can you, when you say risky, you don't mean standard like international default risk. You mean just the covariance with the marginal, with the kernel?
Yes, the statement about risk. So when I say risk-free, I mean zero beta, no covariance with the pricing kernel. And when I say risky, I mean a large negative covariance with the pricing kernel.
Thank you.
Yes, that's right. So I'm not, this is actually an important point. I'm using asset pricing lingo here. When I say risk-free, I mean zero covariance. That's an important point. I'm not talking about whether or not there's actual default.
Thank you.
Thank you. That's actually a good thing I should have pointed out. So let me actually show you some of the results. So what we're going to try and do is develop a model, a flexible no arbitrage model that we can use to price a claim to T and to price a claim to G. And below, what you see here on this slide is a graph where I show you the risk premium that an investor demands for holding a strip that pays off either taxes, say 10 years from now, if the horizon is 10 years, spending 10 years from now, or GDP. So what are the risk premia that investors would demand? And our model allows us to estimate these risk premia. And what you can see is intuitive. Given what I've told you about the business cycle risk exposure, investors will demand more compensation for holding tax risk, that's the orange dotted line, than holding spending risk, which is the blue line, the full line. Why? Well, because in the short run, you're more exposed to business cycle risk if you are long in that tax claim, right? It's very pro-cyclical, the cash flow risk. And then in the long run, of course, we know that these risk premium all converge to the risk premium on an output strip. Why is that? Well, that's because in the long run, if spending on the one hand and tax revenue on the other hand are co-integrated with GDP, then they're equally risky in the long run as GDP. By the way, we know that that sort of long run risk is very important when you're pricing risky assets. And in fact, what we know from the asset pricing literature is that you need models, asset pricing models, that have permanent shocks to marginal utility. In this class of models, what you will see is that these long run returns on GDP strips will be above the long end of the risk-free yield curve, okay? And that is exactly what this plot shows you. At the long end, it doesn't converge to zero. You're, say, 2% above that. So that's consistent with what we've learned in asset pricing from that literature. This long-run risk is going to be priced, and investors want to be compensated for taking on that long-run risk. So just to summarize, if you want to think about it in terms of a government risk premium puzzle, our analysis says, look, you know, it looks like that tax claim is a lot riskier than the spending claim, because in the short run, taxes are pro-cyclical, spending is counter-cyclical. In the long run, they're equally risky. That gives you this no arbitrage lower bound on the real expected return on treasuries. If you want to put some numbers on it, we estimate that real expected return on the tax claim on the whole thing, now I'm not talking about strips, but on the entire stream, is close to 500 basis points. So this would imply that we should expect to see real returns on the entire treasury portfolio that are around 500 basis points. That's not at all what we see. They're much lower, right? So there's a big gap there. It's more like 200 basis points, 220 basis points, and that number is flattered by a secular decline in rates that probably wasn't anticipated. So I think that's even probably a fairly generous estimate of expected returns. So to summarize, interest rates on government bond portfolios in the data are sort of lower than what the risk-adjusted interest rate on the surplus claim would have us believe. And as Pat pointed out, this is, when I say risk-adjusted, I'm talking about business cycle risk here that is sort of implicit in the government debt. So this is kind of the risk premium statement of the puzzle. But the flip side of this is you could go back to that valuation equation that I started out from, and you could sort of do a decomposition where the first component just says, let's forget about these covariance terms, about these risk premia, and price everything off of the risk-free yield curve, E of M, That's the risk-free yield curve you're pricing off of. So now you're just using those discount rates. And then the covariance terms, those take the risk premia into account. Now, when you look at this, you quickly realize, first of all, the projected surpluses tend to be small and close to zero. I'll come back to that. But then the covariance is pushed sort of the wrong way. And what you're going to end up with is that the model tells you that the value of treasuries is actually much lower than the actual market prices we observe in financial markets. So that's another way of looking at the puzzle, which is a government debt valuation puzzle. Okay. How big is this? By the way, I should say here that the standard errors around these numbers are large. We're not actually reporting those, but there's a lot of uncertainty associated with these estimates. We try to do a little bit of robustness, but they're large. So for example, in our baseline model, we find that the value of the surplus claim is on average 4 times GDP off compared to the actual market value. So there's sort of a big gap that we're trying to explain there. And so then the question is, what are we missing? And I'll come back to that in a second. Before I do that, let me quickly give you a little bit more detail on the analysis. So these plots that I showed you, where did these come from? I haven't actually put the full model on the table yet. So what we do is we use sort of a flexible no arbitrage asset pricing model. That's a choice of convenience. We could have done something else. And in fact, in the paper, we use a fairly standard consumption-based asset pricing model as well, which for some of you might have been sort of more familiar. We actually get similar results. What do we do with this model, with this flexible no arbitrage model? Well, the model has sort of a vector auto-regression component that we use to forecast primary surpluses in the future. That's sort of one part of the model. Importantly, and this goes back to what Tom was saying in the first talk, we're going to impose co-integration between tax revenue and GDP on the one hand and spending GDP on the other hand. We have 2 versions of the model in the paper. One version has the actual debt to output ratio as a predictor in the VAR. We also have an auxiliary model where we drop the debt to GDP ratio, but instead we impose co-integration of dividends with GDP, because remember, we're also pricing stocks, and that's very important. We want to make sure that we're properly pricing output risk, and equities are very informative to sort of infer the price of output risk that investors get in financial markets. That's the sort of VAR component of the model. We have to, of course, estimate a bunch of risk prices in order to be able to do the valuation exercise. What we do is we try to insist that the model price bonds and stocks accurately. Okay, so that's the way this model is going to work. And then what we do in this sort of flexible affine model is we get an expression for the price dividend ratio on the tax claim, which is the value of the tax claim divided by taxes. We do the same thing for spending. And then when you put everything together, T times the price dividend ratio on the tax claim minus G times the price dividend ratio on the spending claim, that is the model implied debt to GDP ratio. Note that we don't impose that this model implied number is actually equal to debt to output when we put in the state factor. Why not? Well, because this is not affine. If the government commits to a tax and spending policy, in other words, it cannot also commit to an affine debt policy. You could have taken a different approach, which we do in a related paper, where you say, let's suppose the government commits to a spending policy and a debt policy, and then back out what taxes have to look like in order to make sure that this equation is satisfied. That gives you a restatement of the puzzle. The model implied text to output process is much higher than the actual text to output process. So that sort of gives you a different perspective on the valuation puzzle, but basically the results are pretty similar. Okay. So now the question is, what do you make of this, right? What are we missing? Because we're off by a lot. And so the first thing that I want to think about is something that President Bullard alluded to earlier in our discussion of Christina's paper, which is the specialness of US bonds. Clearly, US Treasuries play a special role in international financial markets. They provide safety and liquidity denominated in dollars, which is the world's reserve currency. And it is not inconceivable that investors earn convenience yields as a result. What do I mean by convenience yields? Well, let's allow for the possibility that investors want to overpay for a bond. So they're not just going to pay the expectation of the pricing kernel for a 1-year zero coupon bond. They're going to pay a little bit more for that. And that's governed by lambda. So lambda is sort of the return they're willing to forego in order for them to get access to the safety and liquidity of treasuries, okay? And we're going to infer lambda t from other asset prices. I'll tell you that in a second. Now, if you do that and you go through the same steps that I went to when I started this talk, you get a new version of the one equation, which this paper is about. This is a one equation paper, but now instead of just looking at the present discounted value of primary surpluses, you're going to add the seniorage revenue that the Treasury gets from the ability to sell these bonds at what are arguably, from a no arbitrage perspective, prices that are too high. So then the question is, well, how big is this? Is this big enough to close the gap? Okay, so what we're going to do is we're going to follow Krishnamurthy and Vissing Jurgensen. They say, well, the way you can infer how big this lambda is you look at commercial paper T-bill spreads at the short end. At the longer end of the maturity spectrum, you can look at the gap between AAA corporates and treasuries. And they come up with a number like 60 basis points on average, okay? Convenience yields are also, by the way, counter-cyclical, which goes in the right direction, because if you add sort of this counter-cyclical seniorage revenue term, it makes the surplus less risky. So this is all good news. The question is this big enough? Okay, so we re-estimate our model, taking into account these convenience yields. And so you do get a nice bump. It closes a part of the gap, but not the entire gap. The present discounted value of these convenience services, of the seniorage revenue, is bigger than GDP. It's about 122%. You might wonder, why doesn't it do more? Well, there's sort of an offsetting effect, right? If I tell you that treasury yields have a big convenience yield in them, then I'm also telling you that the actual risk-free yield curve is much higher than you thought it was, right? And so that kind of pushes in the other direction. So that's why you don't necessarily get as big a kick as you might have thought. How large a convenience yield do you need to actually fully close the gap? Well, it has to be much bigger. Convenience yields, the revenue from these convenience yields, which, just to be clear, is a convenience yield times the total outstanding stock of debt, would need to be about 22% of tax revenue on average, and it's much smaller in the data. It's only about 2%. So there's definitely a big gap. Our take is, if you use these sort of conventional measures of convenience yields, that's not going to do it. It's not big enough. It leaves open a possibility that this is not the right measure of convenience yields. And there's some work out there, for example, by Ricardo Rees, by Marcus Brunermeyer, and Yuli Sannikov and their co-author, that sort of tries to argue that if perhaps we should be using a broader measure of convenience yields. I'm gonna leave that as an open question for now, but it doesn't seem like this is big enough to close the gap. Now, the other possibility, and this comes up whenever we present the paper as well, look, maybe the way you're forecasting primary surpluses is way off. And of course, we have to be humble in recognizing that forecasting primary surpluses is hard, and it could be that our forecasts are off. So what we do here, and this is sort of to guard against this possibility of misspecification, is we say, okay, all right, let's assume that there is a probability of a significant permanent spending cut that's going to happen with some probability phi in the future. We envision the spending cut, pick a really big one at 2 standard deviation innovation. So then the spending would decline from 11% of US GDP to 6.6%. What we then do is we say, well, let's reverse engineer the phi that actually closes the gap completely. And that's what you see here plotted in the time series. On average, that phi is 23%. So it's very large. Investors would have to anticipate this peso event, but they impute a probability of this happening every year with a 23% probability on average. And in the last decade, that number actually increases quite a bit. So in some sense, this suggests a restatement of the puzzle. It could be that investors are anticipating a large fiscal correction, but they seem to overestimate the probability of this happening. I think it's fair to say. You could flip this and think about a major increase in tax revenue. It's sort of symmetric. You're going to get very similar results. The probability of a major fiscal correction has to be fairly high, especially in the last 3 years or so. Okay. Then the last thing that I want to briefly mention is a point I touched upon on the first slide. If you go back to that fundamental valuation equation, there's this sort of nuisance term, which is the tail value of debt discounted back to today, where you're looking at debt in the distant future. You could call this sort of a bubble term. So the point I want to make here is that in an environment where output risk is priced, even when the risk-free rate is smaller than the growth rate on average, this will typically converge to zero. And the reason is that there's an output risk premium embedded there, right? So let's look at this equation, but let's assume that the debt to output ratio is constant, B, to keep it simple. Well, then what you're left with on the right-hand side there is the price of an output strip of a security that pays off output in the very distant future. And we know that that's going to have a fairly large risk premium embedded in it. In fact, I showed you those plots for GDP risk premia early on in the talk. So the point being here that these transversality condition violations are going to be hard to sustain in an environment where output risk is priced. And we know that investors want to be compensated generously for taking on long run output risk.
I know, you have 5 minutes.
Okay, oh, that's great. I'm actually done. So let me conclude. Was there a question as well? I thought I heard someone. Okay, so let me conclude. To summarize, if you look at a portfolio strategy where you're buying all of the outstanding treasuries when they're issued, the cash flows that you get as a stand-in investor are quite risky. And I want to point out here that this is not just a hypothetical exercise, right? If you own a broad Vanguard treasury fund, then the cash flows would look roughly like the primary surplus. It's not just a hypothetical exercise. So there's a lot of cash flow risk in there, but somehow that's not reflected in the valuations, okay? Bottom line is that bond yields are puzzlingly low. We thought that one way out would have been, well, there are big convenience yields on treasuries. We think those are real, but conventional estimates of these convenience yields are much smaller than what you would need to completely close this valuation gap. Okay, so that leaves us to conclude that perhaps investors are simply much too optimistic in the US with respect to their beliefs about a fiscal correction. And we've done some other work where we're looking at Congressional Budget Office projections, which are fairly sophisticated, which show that at least in the past 2 decades, of course, these 2 decades have been anomalous, these forecasts have been much too optimistic. Of course, these are projections rather than forecasts based on current law, but still that suggests that there might be something to this notion that Treasury investors have been much too optimistic about the size of future surpluses in the past couple of decades. So let me end right there.
Right. Well, thank you very much, Hanno. And with 2 minutes to spare, so let's move on to the discussion, and then we will have a bit more time for questions in the session. So Lars, you're up.
Okay. Well, it's a great privilege to be involved in this event. Of course, there's the work we're honoring here by Tom and Neil is, and as well as much of their other work, has been very important in framing macroeconomic policy questions. So this is an interesting paper to talk about, and there's lots of valuable issues floating around here. And so let me go ahead and give my 2 cents worth on this. I'm going to have a rather different perspective about on this discussion, and in order for me to really get at some of the key issues, I'm going to have to open the hood on stuff that Hanno apparently chose not to open the hood on. And because I think it's how the calculations and constructions are done are really quite important. And so I think of this as the following. We had this previous talk by Tom about his work with George Hall, and now what we're going to try to do is we're going to try to take the surpluses, figure out how to assign the corresponding prices to them that adjust for uncertainty, and then study the present value relationships. And then when Hanno and his co-authors do this, then they uncover some puzzles and they uncover some challenges, and the question is, what are those challenges? So let me start off with this. The paper and the talk spent a lot of time on returns and try to pose this puzzle in terms of returns. I frankly found that 3/4, a lot of that is almost a distraction, and I will elaborate why. These are not the returns Hanno was talking about, are not returns that he was using market data on. They were constructed returns. So really, this is about the present value relationship. In order to compute those returns, you have to compute present values first, and then construct returns from that. So what I have in mind here, well, the question is, does the debt, is it connected to the appropriately stochastically discounted future taxes and then future government expenditures? Apparently, I have trouble with minus signs here. I apologize for this, but I do understand that there's that we have to, surpluses are the difference and not the sum. So I guess I did this too early this morning. But with that in mind, the question is, will this relationship hold? So the 2 variables on the right-hand side are constructed variables. They're not things that we have direct observations on. So they only have meaning once we put down specific models for the so-called stochastic discount factors. And then from those constructed variables, we can figure out values, and from those we can then deduce returns. So this return anomaly that we're talking about is really fully off of based on constructions. And so I find it more productive to just short circuit it and let's just talk about present value relationships, which is really what this paper is about.
Sergio pulled up the presentation for you, so he can also run it on our side if that works.
You should unmute, please, Christina.
I guess that's why.
There we go. Sorry, Lars, about the glitch in the matrix. Go on.
Well, they may have been very insightful comments on Hanno's paper. I couldn't tell. So anyway, the answer is going to depend on how these terms are quantified, and that's why it's very important that we kind of open the hood on some of the calculations. So now the first way that we can often proceed in these type of present value calculations is to impose some type of balanced growth notion. This is what Hannah was talking about in terms of co-integration. So I'm going to take that present value relationship. Again, I apologize for not being able to handle minus signs early this morning, but I'm going to divide through by some growth process. It's proxied in their paper by output, and as in the Hall and Sargent paper as well. But in general, there's some type of stochastic growth process that's moving around, and we're going to scale things by it, right? And we can and we're going to scale both the debt, and we're going to scale the taxes, and we're going to scale the government expenditures all by the same common process. And then you can kind of restate all the various formulas now in terms of these objects. And for empirical investigators, for econometricians and the like, it's kind of nice to have things that behave in more stable fashions and to try to characterize nice time series properties of things. So the scaling is done for that purpose. Okay? And so now what you want is you want the product of this kind of M times Z to be to stochastically discount. Okay. Now here's where Hanno discussed a lot about, mentioned co-integration, but as I understand what they did is not that. They did something a little bit different. They imposed a distinct geometric growth rates for taxes and expenditures. And they claim they have to do this to get the vector order regression to behave nicely. And so therefore, in some sense, one of the two terms dominates. And as I understand it, one of these is positive and one of these is negative. We really expect that government expenditures are going to forever grow at rates faster than output of the like. It looks to me like, I mean, if we're going to be making these trend growth adjustments in order, then that's going to affect the present value relationship, and that's going to be kind of fundamental to what that to some of the calculations. Now, it may well be that these adjustments that they're making for these growth rates are like so innocuous and they discount it out in the future that extrapolating out in the future really doesn't matter. But I think it would be good to actually show us this in practice. If we're making ad hoc adjustments like this to make the co-integration model work, it'd really be good to show us what its consequences are. So let me just put on Sargent's, one of Tom's graphs with his paper with George Hall. This is the ones that are looking at the receipts and outlays. Relative to output. Okay, so it's that there's some type of movements here. I don't really see them necessarily moving in a little bit. The trends moving in a little bit different directions here for this, but this is a much longer time series, I think, than what Hanno and Sten are using in their analysis as well. If you look at the differences, it's not really clear that we need to, it seems to me like these differences are kind of offsetting themselves, and these trend growth adjustments seem to be, for this purpose, not terribly critical. What's more interesting, the fact is you get these big spikes, and whether the time series models we're looking at are really good, doing a good job of capturing these spikes and blips, major blips up and down is certainly an interesting question, and one that I would think is worthy of more exploration. So I'm, whenever I see these in kind of stochastic evaluations and risk adjustments, these trend growth adjustments, I get a little bit concerned. And this may be small potatoes, but it'd be good for the authors to convince us of this. And my guess is they actually know the answer to that, and they can, in their rebuttal, can elaborate on why it's a small issue. Here's the corresponding to debt to GDP type calculations. Interestingly, in the vector order regression, when they put in debt to output, not only do they have different kind of trend differences, they have a break in it. They do some type of chow test, and they figure out that they need to do different things for over different segments. If we're going to start putting breaks in things based on chow tests, don't we want to start thinking hard about what's underlying those breaks and what the consequences of that? again, I get nervous when we're kind of doing these type of data decisions without simultaneously thinking about their consequences in terms of the overall calculations. So it seems to me like we really backed off a little bit on the co-integration model in terms of the implementation. At least this is what I've read. This is how I read their paper. And I'm not, and I think it's worthwhile considering whether that's really the way we want to go for this. Now, there's some econometric issues here. This is really in the weeds, but they refer to the success of the co-integration tests. But the test they do is a test of a rank of a matrix. And really what you care about here is not the, and then they claim by this test of Johansen that indeed there's a reduced rank of 2 dimensions, suggesting that the co-integration, that relationship they have is a good one. But they should show us what they imply. To report tests like that, you should really be showing us what the implied co-integrating coefficients are. Because you can have reduced ranks without having them being reduced in a particular way. And the co-integration story we're telling here is one in which the so-called co-integration coefficients are kind of pre-specified. It's not really clear that the Johansen test is really the right thing you want to be doing because you need to be, because you care about the coefficients themselves and you have pre-specified notions of what they should be. I'm mildly skeptical about these tests in general, but if we're going to do them, I think it'd be good to choose ones that are more revealing and to as indicated, if you do these co-integration tests, the question is, did they do it before or after they'd made these adjustments in these trend growth rates? If they did it before, then why didn't it detect? Then why didn't it detect the need for putting these trend adjustments into the vector order regression? So I just couldn't tell in terms of the way they did things. It may well be stated clearly in some appendix, but I missed it. And as I said, the debt to output model does these kind of 2 regimes supported by a Chow test. What's going to happen in the future? Are there be more future regimes? And what's triggering these regime shifts if we really think they're there? So again, I would rather you be thinking about this in terms of the underlying economics driving things and not just direct Chow tests. Okay. The paper discusses, and Hanno mentioned in his talk, that they've done their vector order regressions 2 different ways. And as far as I could tell, this is in part based on some exchanges that they've done with John Cochran. I'm not privileged to what the details of those exchanges are, but I know something about the origins of some of these discussions, and I think it's good to kind of remind ourselves of what's behind this. There's a kind of a broader lesson here about studying models under rational expectations, in which for certain settings, it's really important to look for methods that are robust to assuming information structures. That is, do you want to be able to specify exactly what the information structure is, or do you want to potentially allow there to be omitted information in different forms? And certain methods allow for, certain econometric approaches allow for that, other ones don't. And is there, are there reasons to be concerned about this? So originally in this present value literature, this was a case in which this concern about information became relevant. There's this paper which is dismissed in a footnote in this paper that I wrote with Tom years ago, in which we look at, in the case of constant discount rates, which of course we know is a highly stylized and not terribly empirically relevant example for many purposes. We expose a flaw in a mechanical use of VAR evidence in studying present value relationships based on surpluses. It shows that if you look at surpluses alone, that in kind of so-called stochastically non-singular VARs, that the present value relationship couldn't possibly be satisfied as an artifact of the VAR. And then if you add in the debt positions, which would reveal more information, that would then cause problems because with the stochastic singularity. Now, as Hanno and collaborators are clear, that's a very highly stylized example, and it's one that's not terribly relevant to their calculation. But I think they're kind of missing the message of that literature because of overreading too much into that example. The case of variable rates are discussed in a paper, and extending into that case using Campbell-Schiller type calculations are extended in a handbook chapter that I wrote with John Heaton and Nan Lee and Nick Rusinoff. Now, here you got to buy into the log linearizations used in Campbell and Schiller. Lots of people do that. I think I'm happy to take those with a grain of salt. But again, there's an interesting observation that comes out of there, because now we are going to allow returns to vary. And so now what happens is you get, not only do you get the kind of cash flows in our case, in the Campbell-Schiller case, dividends, but you also get returns showing up in these kind of present value type in these present value type relations. So whatever rule there are stochastic discount factors, they get loaded into expected log returns in their under their log linearizations. And a very similar observation shows up that came out of this earlier work, and that's the following. That if you take the Campbell-Schiller type of analyses and you do vector-order regressions with returns and dividends, the present value relationship can't possibly hold for mathematically the same type of reasons. The way out of that is to drop the returns and to use the and to then use price dividend ratios. Price dividend ratios reveal more information. With that additional information, then there's a sense in which you're back in business, but you're back in business in a way that makes the Campbell-Schiller version of the present value relationship hold by construction instead of there's no longer something to test. But the important part of these type of exercises, A, is information. Allowing for misspecifying information can have big consequences in some of these type of calculations, and looking at things like values to cash flows can be very useful in terms of revealing information that can that econometricians might miss that economic agents have. It's kind of an interesting flip side to this old Grossman-Stiglitz literature about looking at where prices reveal information to economic agents. Here it's that the prices reveal information to econometricians, even though economic agents might even have access to that information. But I do think it's good to keep your eyes on the notion of robustest information sets. So it's very good that Hanno and his co-authors are investigating these relationships with these ratios.
Sorry to interrupt, but you're out of time. If you
out of time, okay.
Yeah.
You're gonna have to give me a couple more minutes to finish up then. I'm gonna have a few different. I will make my remaining observations somewhat quick. Now, when you include the debt to output ratios in the vector-order regression, there's a couple of issues that show up. One is that, as Hanno notes, the fact that if you put this in the vector-order regression, there's this internal inconsistency between that and the present value formula, because the present value formula, which you compute, is going to be doing things like sums of log normals and the like, and that's not going to be internally consistent. Now, this paper may not care so much about that because it's not about testing things like present value models. And this problem is hardly unique to this paper. This is kind of well known in this whole literature. But it is a little bit awkward that there's an internal inconsistency there, and arguably this is a problem of taking the model too literally, how it's done. Now, something else that would be useful to check on the vector-order regressions when they do include these values into the vector-order regressions is you can directly look at the vector-order regression. You can take calculations like I did in my paper with Schenkman and directly check on these kind of terminal valuation conditions, which Hanno makes reference to, and would just be good to verify from those that those are satisfied. Relatedly, while the paper fits stochastic discount factors, which pushes it differently from standard Campbell-Schiller calculations, it's fitting these empirically to a bunch of asset returns. It would be good ex post to show us that those stochastic discount factors are pricing government debt correctly. And to do this statistically is challenging because of the way that they construct the stochastic discount factors. But it'd be good to do this using, again, debt to output as the conditioning information as just an additional check that things are working well. Now, the comeback to this is they're fitting a bunch of the term structures, so hopefully this will work well. But I think it's useful. To do that check. The paper, to my taste, becomes much more interesting when it starts talking about convenience yields and peso events. These peso events are related to what I was talking about before about these, how we're treating these trend growth rates and the like. And I think it goes beyond peso events. How do we really want to think about low frequency movements in these trends? And I think it'd be good for the paper to get to these issues much more efficiently. As I indicated, I think it's good to just verify that the return to government debt satisfies the Euler equation. It'd be good to do the VAR check when debt to GDP is included in it. I think it'd be valuable to include longer time series and to replace the deterministic time trend differences with more interesting stochastic processes. And finally, the resolution is that agents have distorted beliefs, and that's going to fix things. But there's this observational challenge in terms of risk premium versus beliefs that they're kind of very hard to disentangle. And so maybe we need a more flexible models of say stochastic discounting more generally in order to address these type of challenges. Thank you very much.
Thank you very much, Lars, for a great discussion. And I guess we can start with Hanno, if you want to just briefly reply, and then we can move on to questions.
Okay, thanks, Lars. That was a great discussion. You touched upon all the important issues. Let me perhaps start by commenting on why we did this trend adjustment. So if you look at the tax revenue of the federal government in the post-war sample, over GDP as a fraction of GDP, that's sort of slightly trending downwards. That's obviously an issue if you want to use a co-integrating vector 1 minus 1 for tax revenue and GDP. If you look at a longer sample, so if you go back to the graph that Tom showed, where you start saying 1900, that's much less of an issue. So then you might ask, well, why didn't you just do that? Go back all the way to 1900. We could do that because we have the Hall Sargent data. That's something we have thought about. Perhaps we'll go back to that. But the issue there is then, I think, especially after the Second World War, there's this period where there's effectively yield curve control, and we were hesitant about imposing all these no arbitrage restrictions for that part of the sample. So that is what motivated us to make this adjustment. I will tell you that when we look at the long run forecasts of our VAR for spending growth and tax revenue growth, the model does fairly well, but we'll think more about this, and we appreciate all the suggestions. Let me mention one more thing, and then I'll open it up for questions. I don't want to spend too much time on this, because I can follow up with Lars later. With respect to debt to GDP, so we had a discussion with John, who argued you ought to be including debt to GDP in the VAR. That's a very sensible point, because, well, that should predict government debt returns and surpluses. There's two issues there. One is debt to GDP in the US is extremely persistent. So that creates all sorts of econometric issues once you include that in your VAR. That's why we also explored a specification without it. Relatedly, it turns out that debt to GDP does not really forecast returns or surpluses. We think it ought to. It turns out it doesn't. So we think the most elegant approach there is actually to not have it in the VAR at all. But that's a point of contention. John didn't seem to agree with that, but that's what motivated us to explore this alternative specification. And then finally, let me just say that if you take a step back, all these issues you've raised about specification are very important. But if you go back to the first thing I showed you, once you accept that the tax claim is riskier than the spending claim, you end up with a puzzle regardless of all these issues of specification and forecasting surpluses, because then that immediately tells you just from no arbitrage that the expected return on all treasuries is bounded below by the expected return on that tax claim. And that's now, it's true that that number is not a number you can look up on Yahoo Finance. It's a number we estimate, but it certainly looks like it's very risky. And so that's really where the puzzle lies, I think. So in that sense, I think it's quite robust, but perhaps we can talk more about that. Okay, I'll stop here and open it up to questions. Thanks, Lars. That was a great discussion.
All right. Thank you, Hannah. Let's start with Pat, who's had his hand raised for a while now. So go ahead.
Thanks for the paper. So I remember there's this old literature in stochastical G models, Belasco shell, that look for the generalization of the R less than G type arguments for a general case for Pareto optimality, and all the stuff that Christina talked about with deterministic R less than G. You might conjecture that even if there are long-lived investors, if they have those broken up budget constraints because of the borrowing or whatever, it will turn an infinite horizon model into what looks like an OG model in the same way. And then could you check the Belasco shell? It's basically certain, it's certainly like, does your pricing kernel have the right properties so that these infinite sequences are priced in the right sense in the appropriate space? And this is beyond my sort of knowledge set. My brother knows it backwards and forwards, but I think that you could connect it to that a little bit. And then even if they're infinite horizon, you could say, yeah, but if we have these binding borrowing constraints once in a while, it chops up the budget constraints. So it acts a lot like mathematically like OG. So that's a little bit vague. It's just a suggestion.
Okay, let me briefly take a stab at that. That's an interesting point, Pat. So one issue that I see there is in an environment where there is an equity premium, if the risk-free rate is always lower in every state of the world than the growth rate of the economy, you inevitably end up with arbitrage opportunities. Why? Well, if I can borrow at the risk-free and I go long in stocks, now there's a money pump. So I'm going to have to discipline this somehow. You cannot literally have the risk-free rate be lower than the growth rate of the economy in all states of the world. And in fact, in any asset pricing model you'd write down, that wouldn't be the case. It could be that on average, the risk-free rate is lower than the growth rate for sure. In fact, that's probably going to be true in your canonical Campbell-Cochran or long-run risk model. But I'm not sure that you could actually have the risk-free rate be lower than the growth rate in all states of the world, because that would be, I think, an arbitrage opportunity. So I have to think more about this question, but I suspect that in a lot of these models, effectively, we're granting the government arbitrage opportunities if we insist in an environment where there's aggregate risk that's priced, that the risk-free rate is always lower than the growth rate of the economy. Now, in some sense, you could say, well, that's what convenience yields do. Convenience yields effectively push the risk-free rate below the growth rate in a lot of states of the world, I think. But the twist there is, of course, that convenience yields disappear if you keep supplying debt. As supply goes up, these convenience yields would go away. So I'm not sure that that's a way out, but I will take a look at these papers that you mentioned, which I must admit I'm not entirely familiar with, but I should be. So I'm going to take a look at that.
It's connected to you imposing the TVC that you chatted about. So
yeah.
Anyway, you should talk to people more knowledgeable than me. Thanks a lot.
Thank you.
Marco?
I was wondering whether there's any way you could come up with bounds for the concerns that Lars expressed. Because, you know, to me, what stands out, if you go back to the picture that Tom had and Lars used, is there are these giant events like World War II. That's a period of terrible private consumption, and the government is raising 25% of GDP a year. You know, in any kind of macro model, certainly the present value of that would be very big, and we should see it, and we don't see those surpluses coming in the future. So if there's a way of coming up with bounds of those things and saying, look, there's just no way that these things would the surpluses that we see would be enough. The other event that I'm thinking is it might be worth looking at other countries, and one that could be particularly interesting, I think, is Italy, not just because I'm Italian, but because they've been delivering primary surpluses. Well, not recently, but up until recently, pretty consistently. So they went for a period with a lot of borrowing, a lot of debt, and then that switch. And so then the question is, if that's kind of the stochastic process in the background, what's the probability that the US turns into Italy has to be for this to add up?
Those are great suggestions. Thank you, Marco. Yes, we're actively looking at other countries, applying this valuation methodology to other countries, sort of as an out-of-sample check. We'd actually be looking at the UK because the UK, turns out, has amazing data, both for historical data, both for spending, tax revenue, and market value of debt. And the preliminary results there suggest that there's much less of a puzzle, partly because, of course, the UK has not been running primary deficits that are as persistent and as large, but we need to do more work there. And I also like your suggestion of thinking more about these episodes, like the Second World War and the First World War. I think those are important episodes to study.
Right, Chari, you want to go next?
Yeah, so this is actually following up on Lars's discussion and what Marco just said. In Tom's paper, which led off all of this stuff with George Hall, I think made it very clear when we're talking about government expenditures, what we and debt and taxes and stuff like that. You see these, it's spiky, but at least I prefer to think about this as relatively short-lived, large expenditures followed by a long period. And Tom emphasized this, that effectively primary surpluses were positive and were sufficiently less than G, perhaps because of financial repression after World War II, so that the debt to GDP ratio fell. And Barrow, in his investigation of the UK, and it's great that you're doing the UK, also emphasized this. What I'm concerned about is if the stochastic process that really matters is the spiky stuff, followed by, on average, taxes that are slightly higher, the primary surplus that are slightly higher, but are bouncing around. Is our focus on that relatively high frequency bouncing around going to capture the risks that we're really talking about, which are, unfortunately, because fortunately we haven't had too many wars in our history, but the UK and other countries have had more wars. So maybe there's more information involved in that. What I'm saying is I'm concerned that the focus on business cycle risk may not be capturing the real risk that's going on, which is the spiky expenditures followed by small persistent primary surpluses.
Okay, this important point. I think I should clarify that we're looking at both, right, Vivi? So we're looking both at high frequency business cycle risk, and there you sort of unambiguously conclude that the tax process is going to be riskier than the spending process just because of the cyclical nature. But then we also look at the long run output risk because we impose co-integration. So in the long run, we're saying, well, taxes and spending are co-integrated with GDP, and investors want to be compensated for that risk as well. And actually, quantitatively, that's very important. So I think we agree with you that it's not just about business cycle risk. In fact, for these valuations, the long run component is very important, and that's where GDP risk dominates. And we capture that by insisting that taxes and spending be co-integrated with GDP. And so that's all priced. Now, of course, the question is, how do you infer the price of long run output risk? Well, we have to do that indirectly by looking at stocks and related securities, right? We can't directly observe how much investors want to be compensated for bearing that risk. But yes, we
Okay.
have that in the model. It's very important.
Thanks.
All right, so what do I see? Two more questions. And so Tim first and then Tom.
Yep. Hey, Shannon, could you let me turn on my screen? Anyway, but the, no, who cares? So no, Patrick's right. And Belasco and Shell were looking at something with, oh, here, now I can. Belasco and Shell were actually looking at generalization of what's called the cash criterion. And I was thinking something like this too. I don't know if it's directly applicable, but the same techniques might be applicable. It's not really that what you look at is the expected value of R&G. Instead, you look at like their reciprocals. What you want is the expected value of 1/1 plus R being equal as being less than or equal to the expected 1/1 plus G. And I was even thinking something like that too. Sorry, Pat sent me a message and I was busy typing something out. It's really worth looking into.
Okay.
Because everybody talks about R and G. It doesn't mean you should look at their expected values. According to this cash criterion, it's something like the expected value of 1/. Anyway, could talk about that later.
Yeah, thanks, Tim. I'll probably follow up and ask you for.
And Tim, sorry, Tim, when that fails, isn't that closely connected to Hano not being able to impose that transfer Saudi looking thing because at a normal prices? You can't do that. I thought then the whole thing doesn't work like that.
Exactly right. I mean, Pat, look. Whether it's exactly applicable because of the incompleteness in the market and so forth, but the math techniques might work. The math techniques might work. And what's interesting is instead of asking for interest rates to be high, you want 1/1 plus the interest rate to be low. But when you take expected values, the expected value of the reciprocal is not equal to the reciprocal of the expected value. You see what I'm saying? And so, Pat, you might be onto something, but oof, that's dusting off a lot of stuff from my youth to think about stuff like that.
Okay, thanks, Tim. I'm going to look into that.
All right, so I see one more question now by John, and so go ahead.
I'll get unmuted here. I just want to follow up a little since Lars mentioned some correspondence we've had. And I want to make Lars's points just a little more emphatically. We learned something by about 1995 in asset pricing. And that was, it's very tempting. Forecast dividends, discount them back with some model, find the price isn't equal to the asset price and proclaim a big puzzle. And it took us 30 painful years to learn that that's a bad idea. And there's two reasons. One is the theorem. There always exists a discount factor, blah, blah, blah. And the other one is agents have more information than we do, Hanson, Roberts, and Sargent. So this paper's kind of violating those two principles, and you see why. When you do, you have to include the value of debt in the VAR because when
we did.
Agent's information, yeah, I'm getting there. Now, what do? They put the value of the debt in the VAR, but then they chop up the sample and then two different co-integrating vectors for taxes and growth. This is what Lars pointed out. You can see specification fishing to get the right answer. And there's deep economic intuition here. What they're doing is they're ruling out the ability of governments to borrow money today, promising surpluses in the future. All these puzzles come out of a specification that forces governments to borrow money today, but not to promise to pay it back in the future. You put the full implications of that in an economic model, and it's just completely crazy.
So really, I think, asset pricing learned this lesson. What the Campbell-Schiller approach, what Lars referred to, is you write down a model where prices reveal information. It's an identity. You can't test the present value relation anymore. You can learn a lot about what discount rates and cash flows are contributing to the prices we observe. And that has been my positive suggestion to the authors all along, and remains my positive suggestion.
Okay, so let me briefly respond to this. I don't think we have to relitigate this, but as I pointed out, as soon as you accept that a tax claim is riskier than the spending claim, then what I said follows. You have a lower bound on the expected return on all treasuries. And so that's a very robust conclusion that doesn't depend on that's robust to concerns about specification. So that's the first thing I wanted to mention. The second thing I'll add is that we've actually done the Campbell-Schiller exercise that John is suggesting in different work. And what we find is consistent with what we find here, that seems to be mispriced. Treasuries seem to be mispriced. Why? Well, because we find that the debt to GDP ratio doesn't seem to reliably forecast either returns or surpluses. In fact, it's very persistent. So there's just not a lot of evidence that the debt to GDP ratio predicts either returns or surpluses. So in that sense, it's very different from, for example, price dividend ratio on stocks, which is a reliable predictor of returns and to some extent dividend growth as well. So I think the treasuries seem to be completely different in that regard.
All right, so let me give the last word to Tom, and then we can switch to the next session. Tom, go ahead, please.
Oh, just this is a Q brother comment. Or just because like this, another paper is a classic paper by Zilcha, which is in that line, and just Andy Abel is working on a version of, I've just seen it on his Blackboard along the lines that the Q brothers are recommending, and with some of the same forces. So I talked to him.
Okay, thanks.
All right. Well, thank you very much. There's some remaining Q&A in the chat. I encourage the authors to maybe try to reply to them directly. And let's move to the next session. So it's my privilege to introduce the second honoree of the conference, Neil Wallace. And Neil, the floor is yours. Please share your slides and your wisdom.
So I'm delighted to have the chance to present at this conference. You might say that this is a talk on a topic that's not related to the paper Tom and I wrote 50 years ago, is it? But I've been doing a lot of work on models of money in the past 20 to 30 years. And only haven't done much on international monetary arrangements. And so here's an attempt to correct some of that omission. I'm going to be talking about fixed and floating exchange rate systems and a comparison across them in models in which prices are flexible. And one case against floating exchange rates when prices are flexible rests on exchange rate indeterminacy. And that indeterminacy arises when currencies of different countries are perfect substitutes, at least over some range. Today, I'm going to be talking about a model which also has a mild case against floating exchange rates, mild because I'm not smart enough to state and prove a theorem. I can only present a couple of suggestive examples.
But this is going to be a case that's consistent with no observed substitution among currencies. And so if you think you don't observe much currency substitution, that's the empirical basis of this paper. So I'm going to sort of quickly turn to the model. But I want to say a few words in a general way about the nature of the model. These examples are going to appear in a model of two symmetric countries. And the countries are going to experience country-specific aggregate real shocks. Why do we want country-specific aggregate real shocks? Because everyone has always thought that if there's a difference between fixed and floating exchange rate, it's going to appear when there are country-specific shocks. In the examples, I'm going to be talking about conditions on parameters under which we can implement first best outcomes. And it's going to turn out in these examples, which I hope are suggestive, that the set of parameters under which we can implement the first best is strictly larger under fixed exchange rates than under floating exchange rates. And because fixed exchange rates and a unified currency are identical in the model, these examples constitute what I think is a new argument in favor of unified currency. So the model is going to be a monetary model. And I want to have a very simple representation of a foreign exchange market. This goes back to almost classical ways of modeling exchange rate intervention. So the model is going to contain home and foreign currencies. For reasons I won't go into, if I'm going to have a model with currencies in them, I want the currencies to be playing a role, not to be just some ad hoc add-on in the model. And the simplest way to do that is to have a pure currency model, one in which currencies are the only assets and in which all trade is spot trade. Because country-specific aggregate shocks are crucial, it's extremely helpful to use a specification in which the distribution of currency holdings that results from prior trades is not a state variable. The models that allow you to do this are very special, and I'll apologize at the end. But in any case, the desire to have this property leads me to use a version of the Lagos-Wright model, a model in which quasi-linear preferences eliminate wealth as a state variable. So here's the model, and this is a model that was developed jointly with Tao Zhu, who's at Hong Kong Science and Technology. Tao and I have somewhat different views about what should be best done with this model. So at the moment, he's not joining me as a co-author of this paper, but maybe he will. So each country is populated by a non-atomic unit measure of infinitely lived people, and each country has its own divisible money, which, aside from the exchange rate regime, will be fixed. There's a common discount factor across all the people. I denoted beta, and it's in 0, 1. So here's the sequence of actions in the model. This is a discrete time model, a person enters a date with a portfolio consisting of amounts of monies of country 1 and country 2. And then the person experiences 3 shocks, or 3 shocks are realized. All these shocks, as I'll describe in a moment, pertain to what will go on at stage 2. But it's important that the shocks are realized before stage 1. So what is stage 1? Stage 1 is the centralized meeting in the Lagos-Wright model. And here, what's traded is a linear good, which enters separately, as we'll see, and 2 monies. And then in the period, people move on and there are stage 2 meetings. And importantly, these will be meetings between pairs. In each meeting, there'll be a consumer and a producer. And exchange rate market intervention is going to occur at stage 1 in the classical way. When the exchange rate is fixed, the 2 governments are going to participate and supply unlimited amounts of their own money at stage 1. That's going to effectively turn this model, not surprisingly, into a 1 money model. And when exchange rates are flexible, we have these fixed quantities of the 2 monies, and there's no exchange market intervention by governments. And it's part of the equilibrium condition that people are going to leave with the exogenous quantities of those 2 monies. So let me tell you about the shocks. There are 2 idiosyncratic shocks and 1 aggregate shock. And as I said, all pertain to stage 2 trade. So 1 idiosyncratic shock is going to determine whether a person is a stage 2 producer or a stage 2 consumer. And each outcome has probably 1/2. So we want to think about half the people will turn out to be stage 2 consumers and half will turn out to be stage 2 producers. The other idiosyncratic shock determines for each consumer whether they consume the home or the foreign good at stage 2, and a constant fraction consume the foreign good. It's going to turn out that what that constant fraction is doesn't matter at all. So you can think of some of the consumers find out they're going to be tourists for 1 period and then return home. Throughout, people who turn out to be producers will stay in their home countries for stage 2. And everyone is in a stage 2 meeting, and the only private information is about history. So people are going to know a lot about the people they meet, but not their histories. So those are the 2 idiosyncratic shocks. They determine whether you're going to be a consumer or producer at stage 2. And for consumers, they determine whether you're going to consume the home or the foreign good. Now, what about the aggregate shocks, which are sort of the heart of the model? The aggregate shocks are going to determine the marginal utility of consuming the home good for those who are going to consume the home good, and the marginal utility of consuming the foreign good for those who are going to consume the foreign good. So the notation are thetas. The superscript is the country, and I is the state, and there are a finite number of states. And you want to look at these expressions here. The period utility of a consumer who consumes Q at stage 1 and who consumes Y at stage 2 of the country K good is Q plus the relevant theta times U of the amount consumed at stage 2. And the analogous condition for someone who becomes a producer at stage 2 is Q minus C of Y. And these functions U and C are sort of standard in this literature. They both go through the origin. They're both strictly increasing. U is strictly concave and C is convex. And margin utility of consuming at 0 is higher than the margin disutility of producing. Of course, Q is this linear good. When it's negative, it's interpreted as production at stage 1. When it's positive, it's interpreted as consumption at stage 1. So I'm going to be talking about conditions on parameters that allow us to implement the first best in this model. And this setting lends itself to a very simple description of the first best. If we can, and this description holds if we consider welfare at the start of any stage 1 before shocks are realized and weight people equally. If we do that, output at stage 1 doesn't enter because, you know, for every positive amount of production, for every positive amount of consumption, there's production, which offsets it exactly. So welfare depends on what happens at stage 2. And the first best just equates the margin utility of consumption to the margin of disutility of consumption. So the first best is an output that I denote Y hat. It depends on the country K because the shocks depend on K, and it depends on the state. Otherwise, nothing special about it. Now, this Y hat, you know, just depends on the shocks and the U and the C function. It doesn't depend on the discount factor or the exchange rate regime. But we're going to be talking about the conditions on allowing us to implement this first best, and they are going to depend on the discount factor and the exchange rate regime. So I said that there would be no substitution among currencies, and we want to implement first best trades. So I'm going to rely on ideas in earlier papers, one by Tao Zhu and me, in which we talked about how we could take pairwise trade and sort of manipulate the gains from trade to induce people to hold and trade with low return assets. And we mentioned there that one possible application of those ideas would be to international currencies. So this paper is doing that. And subsequently, there's a paper by Tai-Wei Hu, John Kennan, and me about the Lagos Wright model. And there we talked about how we could implement the first best there by taking advantage of the fact that we had meetings in pairs and could manipulate the gains from trade. So anyway, our notion of implementability that we're going to be using is the meeting-specific core. And for stage 1, it follows that trade is competitive because we have all these people and they're all participating there. But at stage 2, the crucial meetings in the model in terms of welfare, we're going to manipulate the division of the gains from trade to induce consumers to pay in the form of the producer's home currency and to pay enough. If they don't do that, they're going to sacrifice all of their bargaining power. So here's one kind of game which I want to think about it, or which works. There might be many such games. This is essentially borrowed from that Buchanan and Wallace paper. The game is defined relative to a planner proposal, which here has two parts. One part is a value of country K money that the consumer who will consume in country K acquires at stage one. I'm going to call that amount measured in units of the stage one good. I'm going to call it X sub I for the state and K for the country. And the other part of the planner proposal is a stage two trade. It's going to be some amount which can't exceed what the consumer brought into the meeting, could be less, some stage two trade of that amount of money for the first best output. And so the planner, think of them as making these suggestions about what a consumer should acquire at stage one and what trade should occur at stage two. And there's a stage two game which sort of will induce the consumer to do what we want the consumer to do. And it goes something like this: if actual holdings of the consumer are less than this suggested amount, that is, if the consumer leaves with less money, then the producer in this stage two meeting gets to make a take it or leave it offer. That, of course, is going to leave the consumer with no gains from trade. Otherwise, if the consumer has enough money, the consumer suggests a trade and the producer chooses from yes, no. If the producer says yes, then that suggested trade is carried out. If the producer says no, then the planner's suggested trade is carried out. And you can easily see from this game that the consumer gets a gain from trade only if their money holdings leaving stage one is as large as the planner's suggested holding. If it is, then the planner's suggested trade is in the two-person core. The planner's suggested trade of this first best output for some amount, it maximizes the sum of the consumer's payoff and the producer's payoff. So it's in the two-person core. And that in turn means that the consumer, when he makes this suggestion, can't do better than name the planner's suggested trade. So I hope that makes a little bit of sense to you. But we're going to move quickly to a couple of examples, but before, let me make a couple of remarks. The first thing are some features of this Lagos Wright model. Linear utility of the stage one goods implies that data inverse is an upper bound on the expected gross return on either money in any equilibrium, and that those who leave stage two with money care only about its expected value at the next stage one. So no risk aversion in the pricing of these monies because of this additive linear good at stage one. We're not going to be trying to achieve the first best by using the Friedman rule, which is to pay interest on money at this rate. And we're not doing it here because, as demonstrated in that Buchanan and Wallace paper, getting people to pay lump sum taxes to finance this Friedman rule is not obvious at all in this setting. it places extra restrictions on, I mean, there are restrictions implied by people's willingness to pay lump sum taxes because this is a money model in which trading histories are not known. So I'm not going to say more about that, but we're not going to be doing that. This third remark is kind of important. I mentioned it's obvious that the model under fixed exchange rates is equivalent to a model of a single country with one money and two kinds of stage to consumers at each date. It's a little less obvious, perhaps, and we really didn't set out to get this property, but it turns out that the model under floating exchange rates is equivalent to a model of two countries in autarky, each with its own money and each with one kind of stage to consumer at each date. This holds, I mean, and as I say, we didn't really intend for this to happen, but it kind of pops out. And it happens because the identities of the consumer, whether they're tourists or home country consumers, really doesn't matter at all. Okay, so I'm going to set out two definitions. One, which is conditions on the amounts of money that the consumer acquires at stage one and the amounts traded that support the first best. And the only thing I want to point out here is this R is an expected rate of return. And the only other two conditions here are individual rationality constraints. This is under floating rates. Condition 2 is individual rationality on the part of the producer at the first best level of output. So this cost of production is evaluated at the first best output. And the second condition is individual rationality on the part of the consumer. And the way our planner suggestion and the game is formulated, yeah, it turns out that we can implement anything that's individual. Well, all we require is that these first best trades be individually rational, and we can implement them. And when we do implement them, that outcome is in the pairwise core. And here's the analogous definition for fixed exchange rates. All you have to notice, I mean, this is like a one money model where the return is adding up the real balances in the form of both monies. In general, the restrictions in these meetings, in these definitions, these constraints give us restrictions on the discount factor. I won't dwell on this. It's sort of obvious. I mean, if people didn't care at all about the future, you'd never get producers to produce anything, let alone the first best. So you're going to get restrictions on the discount factor. What's interesting is that these restrictions are going to depend on the exchange rate regime. So I'm going to present two examples. These are trivial kind of examples, but they work in a certain way, and I hope they're suggestive of a more general result that I'm not quite capable at this point of even formulating, let alone proving. So we're going to have two states, and what's going on here? In one of these states, the utility of consuming is just you, That's when theta is 1. And so it's 1 in one country. And in the other country, people don't value consumption at all. And in state 2, that's reversed. And the process is 2-day periodic. So if today in your country, people value consumption of the good, tomorrow, or then whatever the next period is, they don't value it at all. And vice versa in the other country. So this is called a 2-day periodic and asynchronous example. Okay. Couldn't be simpler. So what happens under floating exchange rates? Well, let's take advantage of the remark that we have two separate economies and they're identical. The fact that the timing is off, that people don't care about consumption of the good in one country when they care about it in the other, doesn't really matter. They're two separate economies. And let's let X plus be the stage 1 value of money when people care about consumption, and let X0 be that value when they don't care about consumption. Now, how do we get a monetary equilibrium when no one cares about consumption? How do we induce them to have money? Well, we have to give them a rate of return of beta inverse. And so in order to have a stationary monetary equilibrium, we must have this ratio of X0 to X, we must have the ratio X plus to X0 be beta inverse. Then that implies from the producer's participation constraint that we have to have beta squared times X plus be greater than or equal to the disutility of producing the first best. And finally, when we add in or take account of the consumer's participation constraint, we get the restriction that beta squared has to be greater than or equal to the ratio of the disutility of production at the first best to the utility of consuming the first best. So that's under floating exchange rates. You should have the image that under floating exchange rates, we have these two separate economies, and there's this extreme seasonal in these economies, and one day people don't care about eating, and in the other case, they care about it according to the U function.
Neil, you have about 5 minutes.
How much?
5 minutes.
Yeah, plenty. Under fixed exchange rates, what happens? Well, we have a single economy with a single money, and this economy is constant over time. At each date, it's got two kinds of consumers. Half of them don't want to eat. The other half do want to eat. The presence of the ones who don't want to eat really don't do anything. So this is a constant Lagos right economy. And it's easily seen that the condition for achieving of the first best is simply beta greater than or equal to this ratio of the disutility of producing the first best over the utility of consuming the first best. And you look at these two conditions. Here we had the requirement that beta squared be greater than this ratio. Here we have the condition that beta itself be greater than or equal to this ratio. And this second condition is obviously less stringent than the one that we got under floating exchange rates. So here's my second example. So this is the same example, except that the process is different. It's IID and uniform. So, how do we think of this under floating exchange rates? Again, we have two separate economies. At the current date, people could either value consumption or not. And they're looking forward to what will happen at the next date. And the next date, there's 50-50 probability of them valuing consumption or not valuing consumption. So couldn't be simpler. And then you do a tiny bit of algebra here, taking again advantage of the fact that at a date when the consumers don't value consumption, to get a monetary equilibrium, we have to have them have an expected return of beta inverse to get them to hold money at that. And at beta inverse as a rate of return, they're willing to hold any amount, but that's enough to sort of let us do a tiny bit of algebra. And I've done this several times. It's possible that I made a mistake, but I kind of think I didn't. So now we get a condition for implementing the first best under floating rates that looks like this. And what happens under fixed exchange rates? Well, again, this is some very special example. Under fixed exchange rates, nothing is random here. At each date, we have two kinds of consumers. Some value consumption, some don't. And therefore, we have the same condition that we had in example 1 under fixed exchange rates, beta greater than or equal to this ratio. Yeah, I'm about done. So some concluding remarks. Now, these examples are really very special. One sense in which they're not so
The phrase for everyone.
the fact that I have consumers who don't value consumption at all, inverse, at those value consumption a little bit. Now, two states are quite special. The fact that we have only two states is what's making these outcomes under floating exchange rates non-stochastic over time. Is there a somewhat general result? Well, you know, maybe having two kinds of consumers in the economy rather than one looks like it should require less variability in rates of return under fixed exchange rates than under floating exchange rates. And it's that small variability in rates of return under fixed exchange rates, which makes it easier to obtain the first best. Last remark, how important is the use of Legos, right? Well, it seems pretty important. I mean, I certainly don't know how to handle aggregate risk if the distribution of wealth is a state variable. Well, I'm done. Thank you. So I'll stop sharing my screen. I look forward to hearing the remarks of the discussant and other remarks that people might have.
Well, thank you so much, Neil. And Oleg, if you want to put up your slides and start your discussion.
Sure. Well,
thank you.
Very happy to be here to discuss Neil's paper. It's a big honor, also a huge responsibility. So let's see if I can deliver on that. This is a production economy where money is used for exchange. And so there are two countries, K1 and K2, two types of agents, and each period, an agent can be a consumer or producer, and it's sort of like a random shock. And so there is like one big insight in the paper, which makes the results very clear going forward. And in particular, sort of if you have multiple currencies and exchange rate is not fixed, then the rate of return on holding currency is given by this. And so this is like the price of currency in unit of the good. And this is going from period I to period J, and this is the transition matrix, right? And so and under the fixed exchange rate, you combine the two currencies together. And so the rate of return on holding the combined currency portfolio is given by this. And so the key insight is that once you have the fixed exchange rate, it's equivalent to an integrated economy. And sort of in an integrated economy, you pull risk, and so the requirements on the return that money should deliver are lower, and so it's easier to sustain the first best outcome. What's a more peculiar result is that when exchange rate is floating, the way the floating exchange rate is defined in the paper, it turns out that this economy is equivalent to two countries in autarky. And as a result, it's harder to sustain a situation where first best is implemented because different consumers might want to consume goods of different countries, and so sustaining the first best in two autarkic economies is more difficult. And so as a result, it kind of seems that it should be generally superior to have the fixed exchange rate in this environment. And so Neil goes by showing the examples where, clearly constructed examples where there are conditions on how much easier it is to implement the first best and the fixed exchange rate relative to under floating exchange rate, right? And then deriving a more general result, like what are the exactly limits on the stochastic processes for, say, shocks when the fixed exchange rate is superior is sort of left for future research. So given that search theory of money is not my comparative advantage, I thought that the best thing I can do in the discussion is step back and kind of think of the general trade-offs that we typically see for choosing a fixed and a floating exchange rate, and see which trade-offs are present in this paper and which are not, and sort of how it fits into like this more general choice between floating and fixed. So before going there, it's actually there is an important question of what's exactly is a peg and a float. And so a fixed exchange rate is kind of clear. You look at the exchange rate, if it does move, then it's fixed. So it's sort of, you can kind of infer it immediately. But there is still a question which instrument was used in the background to fix the exchange rate. And using different instruments could in principle lead to different allocations, even if you observe the same fixed exchange rate. So this is something I'm gonna return to. Things are more difficult when, exchange rate is not fixed. What exactly does define a float, right? Like you see that exchange rate moves, but is it a dirty peg? Is it like a partial peg, or is it like a pure float, right? So from the practical perspective, there is a sequence of papers by Elzetsky, Reinhardt, and Rogoff when they just look at the extent of volatility of bilateral exchange rates. And if volatility is low, they're gonna call it partially pegged. And if it's high above some threshold, they're gonna call it a floating exchange rate, right? So, but this is, it's a useful practical approach to this question, but like fundamentally, what do we think as a floating exchange rate? And so there is one sort of notion which is kind of useful, is to say that, well, imagine that there is a monetary policy rule out there which targets something, some monetary aggregate perhaps, but does not have explicitly the exchange rate in the rule, right? So for example, you target consumer price inflation and you ignore what happens to exchange rate. Exchange rate is just determined in equilibrium, and we're going to call it a floating regime. And on top of it, we might require that the government doesn't do foreign exchange rate interventions or does capital controls to manipulate the exchange rate. So in that sense, it's a pure float in some sense, right? What's interesting is you can have quite a lot of exchange rate volatility, but it could be a managed exchange rate volatility. And then under these circumstances, it's not going to qualify as a floating exchange rate regime, right? And so what's sort of interesting is, if you are in a very open economy and the government stabilizes CPI inflation and the weight on imported goods is very high in your CPI bundle, well, it could be that you actually kind of achieve quite a lot of exchange rate stability, even with a policy rule that doesn't target exchange rate directly, right? And so what's interesting is that as economies become more open, one feature of the equilibrium could be that actually exchange rates become less volatile, even if they're not managed. And so in that sense, the extent to which economies are open I mean, will sort of define what is exchange rate equilibrium volatility. And so like comparing what's floating and what's partially pegged is becoming difficult, right? Okay, so the second thing that I wanted to touch upon is like, what are the sets of arguments for and against floating, right? So there are kind of 3 uses of money. And so based on these 3 uses of money, you have arguments whether you want to float or fix the exchange rate, right? And so this paper is about money as the medium of exchange. And essentially the volatility of exchange rate increases the transaction cost of exchange. And this is sort of like a general property, right? If money is useful for exchange, if you have more volatility, some transactions will not be possible to fulfill. This is the cost of it. And there is no benefit because prices are flexible essentially. And so as a result, this is the case against floating. And it seems like it could be a fairly general case against floating using this types of models. So then the alternative models are models where money is used as unit of account. You don't really need it for transaction. You can have a cashless limit, but you use it as unit of account. And there are 2 areas where you can use money. One is you can preset sort of repayment and contracts. You can say how much you need to repay, but you need to specify in which currency. And there is a recent paper by Dobke and Schneider, which takes this approach. And the point is to say that, well, if you have, there are 2 ways how things can go wrong, right? If you require that you never default, then the set of contracts will be limited that you can write ex ante if the currency unit is volatile, because in some states of the world, if the currency unit is volatile, you might not be able to repay. Alternatively, default can be risky. And then in some states of the world, the volatility of the currency might lead to default. And this is another source of sort of like why it could be inefficient. And so there could be an argument to stabilize the currency or have a fixed exchange rate. And it seems that these types of theories would be quite similar to the medium of exchange and the types of predictions that they give, that generally volatility is bad because it limits the set of transactions or mutual beneficial exchanges that could happen. So it's not quite different here from the medium of exchange rate theories. Where things become different are the theories based on presetting prices. So the sticky price theories. And there, if prices are sticky, we by now we have a general, kind of a more general set of results, that it's not only kind of the Friedman special case of floating exchange rate, but more generally when prices of international transactions are fixed, say, for example, in dollars in a dominant currency, it's actually kind of optimal for the government to still pursue domestic inflation targeting and ignore the exchange rate. And under our definition from the previous slide, this was actually qualified that the optimal approach is a floating exchange rate, right? Quite how much volatility there will be in exchange rate and equilibrium is a separate question. There could be little volatility in it and the inflation targeting, but you don't want to target exchange rate directly. But this approach is sort of against the rules of this paper. This paper is about what happens under flexible prices. So this sort of ruled out, and for a while I'm going to set it aside. But where I want to go to is the third use of money, which is the store of value. And you want to store value either across time or across states of the world. And I will focus on storing value across the states of the world, or like the risk sharing reasons for having different currencies. And so it turns out what one can show is that under those perspectives, fixed exchange rates are generally suboptimal. And you want a particular type of exchange rate volatility. It doesn't mean that it's a floating exchange rate. You want a very much managed movement in exchange rates, but you don't want a fixed exchange rate, right? And so why this is ruled out from the analysis in the Niels paper? Well, because it's a quasi-linear environment, there is no need to share risks, right? And so if there was curvature in that outside good, then perhaps there could be a separate role in sort of like the volatility of exchange rate, because this is something that can complete markets, right? And so I wanted to give so Neil had 2 examples in the paper. I'm kind of going to give 2 examples here of how it could work. I mean, perhaps these examples are trivial, but nonetheless, I found them somewhat interesting as the mechanisms are sort of extend to other environments, right? So the first one is the famous Colin-Obstfeld, where essentially you don't need any trade in assets, and just the movements in relative prices, which you can think of either a real exchange rate or more specifically, it's the terms of trade. They kind of implement complete markets, right? You don't need to hold any asset portfolio. You just implement complete market allocation because terms of trade move. Well, this is somewhat against the rules of the paper because it's not about the nominal exchange rate. It's really about the terms of trade. So you need to allow the real exchange rate and the terms of trade to move to adopt it. It really doesn't matter when prices are flexible, where the nominal exchange rate is flexible or not. But this already suggests that some type of exchange rate, real exchange rate volatility is useful. An example which is much cleaner in terms of why it is the nominal exchange rate that matters is if we're going to take a Lucas, trees economy, where imagine you cannot trade equities like in the original Lucas paper, but you can trade bonds, and there are two bonds, one in home currency, one in foreign currency. And then it turns out if you fix the exchange rate, the best you can do is only incomplete risk sharing in expectation. So with the fixed exchange rate, you're just gonna deliver this as the equilibrium, right? Because it's essentially a one bond economy. But if you have an exchange rate and under certain conditions, you can actually find some process for the nominal exchange rate that would actually implement perfect risk sharing state by state. And this goes back to the Lucas Stocky paper that was mentioned in the first presentation today. It's how you kind of use monetary policy to complete the market when you can have state contingent inflation. In this case, it's going to be state contingent exchange rate. And so, constructing the example is very straightforward. I can do something similar to what Neil did in the paper, where there is no aggregate risk about production. We know that the first best consumption is this. You cannot implement it in a bond-only economy. But if you have two bonds, one in home currency, one in foreign currency, then one can show that there is actually an exchange rate process, which is a function of a home country or foreign country endowment, which would actually generate the state contingent trade-offs that implement complete risk sharing. And this creates a case why you don't want the fixed exchange rate. And so this case will persist in many other environments that we write down to the extent markets are incomplete. So what I wanted, if I have a couple more minutes, I wanted to talk about so this is not optimal exchange rate policies. This is just like one example in a very special economy. So I wanted to talk about some more general trade-offs between fixing and floating exchange rate, but more specifically, if you want to let the exchange rate float, in which way you will do it. And the trade-offs typically involve stabilizing output gap if there are sticky prices. If there are no sticky prices, then this is not part of the trade-off. Then there is the risk sharing trade-off that we already discussed, but it will come in two different ways. One way is completing the market like we discussed. The other way is actually reducing risk sharing frictions, possibly. So like eliminating UIP deviations. Can you do something to your exchange rate policy to eliminate UIP risk sharing wedges in the international market, in international financial market? And finally, there is this additional concern as well. When you have that tool, you actually might want to extract surplus from the supply of international bond. If there is a demand for an international bond, the government generally would want to extract surplus, and this would be part of the also exchange rate policy. And so I mentioned that there are multiple instruments how you can achieve exchange rate stabilization. So what we started talking about was the monetary instrument, and you can achieve exchange rate stabilization you're using money supply, right, or an interest rate rule. But you can also do foreign exchange rate interventions, and that could be a different instrument. And also there is capital controls, which is like a tax on an intertemporal profile of consumption, for example, which also affects the exchange rate in equilibrium. And these are three distinct tools in an economy where we have certain features, and the features that I want to have are two. So in order to think about like this general trade-off, you kind of need two features in an economy. You need that in an economy there are PPP deviations, that is, real exchange rate is not stable. If there are no PPP deviations and real exchange rate is stable, it's very easy to kind of get the first best. And the second one, you need UIP deviations, and some type of financial friction or segmented financial markets will typically do this. And so, I'm running out of time, but what I wanted to show is—
Yeah, one more minute.
Oh, one more minute. Well, I don't have much time to show the policy problem, but basically what I'm going to say is the summary result here. So there is a divine coincidence in an open economy. And the divine coincidence sort of goes like this. If on the first best, the real exchange rate is stable, if you don't want the movements in real exchange rate under the first best allocation, then the fixed nominal exchange rate would implement some type of constrained optimum. You really don't need movements in the nominal exchange rate if you don't need to sustain movements, underlying movements in the real exchange rate to do it. And what's the kind of intuition here? Well, if you don't need movements in nominal exchange rate for goods allocation and real exchange rate can be stable, then stable nominal exchange rate also eliminates UIP deviations. So these are the UIP deviations. And without movements in the nominal exchange rate in this economy, even with segmented financial market, UIP will not be distorted, and you're going to be able to achieve the constrained optimum risk sharing. And so as a result, you don't have a trade-off between the goods market and the asset market. But this is very special. It's like an underlying equilibrium without real exchange rate movements. As soon as your first best requires real exchange rate movements, for example, there are Balassa-Samuelson forces that require real exchange rate to move, then it's no longer optimal to fix exchange rate. And the optimal policy will involve some degree of exchange rate movement, but generically it would be a managed float. And okay, so I'm out of time. There is one question I don't have time to discuss. Is our prices sticky after all? Should we put it in? Because that obviously gives one reason why real exchange rate would need to move. And I will just quickly conclude. Basically, I mean, there are arguments why exchange rate can be fixed, and Neil's paper is one argument, and you can think of Dobke and Schneider as another, and it can reduce the risk sharing wedge more generally in other environments. Then there are arguments for floating exchange rate. And generally we would think you need to balance out those arguments, which would result in some type of a managed float more generally. The conjecture that I think is very interesting is if we write down a model which has all these environments, it could be that exchange rate is floating, but quantitatively, it's actually quite close to a fixed exchange rate relative to what we observe in the data with like a 10% standard deviation of exchange rates between pairs of floating countries. And then the question is like, is it policy mistakes that policymakers allow for such volatile exchange rate and equilibrium, or we have something missing in the model? And sort of I would kind of think, what are the ingredients that we miss in the model to make sense of this highly volatile exchange rates in equilibrium? And I'll stop here. Sorry for going over time.
All right. Well, thank you, Oleg. So Neil, there you are. If you want to reply or make comments.
No, I'd just like to thank Oleg for a very thoughtful discussion. I guess, yeah, I was just trying to draw out the implications of a very simple monetary model for a new kind of policy, and I kind of found those examples suggestive. So yeah, let's throw it open to the floor. I really don't have a lot more to say about it.
Well, sounds good. Jim, you're first.
Thanks, Fernando, and thanks, Neil, for coming to this conference and presenting this paper. I once gave a talk called Non-Uniform Currency and Exchange Rate Chaos, and it was to a group of cryptocurrency type people. And so now I'm wondering, in your framework, this is stepping outside the model a little bit, but if these currencies, you've got a very standard kind of thing where the currencies are national currencies, but you could have privately issued currencies which are useful for certain types of transactions, publicly issued currencies that aren't so, they're useful for other types of transactions, and the same kind of switching between the needs of the two consumers. Would you argue in favor of a fixed exchange rate between those two, between the privately issued currency and the publicly issued currency? And to the extent we're not getting that, evidently in the current world, would you have any interpretation of that, or is this just too far beyond what you're doing in this paper? Thanks.
Well, I mean, I haven't really thought about that. I mean, I have given some thought in some previous conferences to objects like Bitcoin. They kind of arouse my interest because somehow these guys who created Bitcoin seem to have gotten around two difficulties that any creator of money would have to deal with. One is a time consistency notion. They seem to have committed to not overissuing in the future, and they seem to have avoided the possibility of counterfeiting. But boy, I'm very far from having models in which I create demands for different fiat currencies. I mean, I did it in this paper by having, the planner devise suggested trades which give special roles to individual currencies. Now, yeah, but I really don't.
So you're not going to let me just interpret the second country as privately issued, somebody else is issuing a currency, and it has some uses because you can buy some goods there that you couldn't buy with the publicly issued currency, and then do all the same analysis, which would suggest, I mean, we're seeing really volatile exchange rates between these privately issued and publicly issued currencies. It would suggest that all of that is your paper would suggest that all of that is a big waste.
Well, I think you can make that argument without my paper. So yeah, I wouldn't go there. I mean, for one thing, my fixed exchange rate system is this classical cooperative arrangement between the two currencies to support each other's currency. And, and it requires both of them to cooperate in that way. They're supplying amounts, whatever people want. Yeah, I don't see how we think about things like Bitcoin and US currency in that way. Sorry.
An honest answer. Okay, David, you're up next.
I could kind of see where Jim was coming from, because literally in your model, you have two fixed stocks of currency. And I guess Jim was thinking that you could interpret the one as Bitcoin because it's fixed more or less. But yeah, you're right, Neil. I mean, these Bitcoin and these cryptocurrencies are run by these decentralized autonomous organizations that almost by definition aren't set up to negotiate or coordinate with some other national government. So it might be tough to fit for that. But my question was, I have to admit, I was a little surprised at the results, which I guess is a good thing, or maybe, maybe I'm just confused, but at the end, you listed, a number of, the simplifying assumptions, key properties of the model, that, the quasi-linearity, two states, et cetera. But would it be wrong for me to think that the key to me, it seems like the key, because I think the two regimes should be kind of innocuous. Actually, this is kind of what I would have expected. They would have delivered the same properties in terms of regions over which you could implement the first best. But it seems to me that the key assumption you're making is with respect to the trading protocols that kind of, if I interpreted correctly, induce the individuals to load up on a specific currency, and in effect prevent them from holding diversified portfolios of the currencies. If you provided some micro foundations of that in the trading protocols, but in general, any restriction that prevents individuals from holding diversified portfolios of currencies, that seems to be the key property. Am I right or am I wrong?
Well, I mean, you could easily convert this model into one that displays exchange rate indeterminacy. And yeah, I mean, just have the planner, suggest trades that can be met by any combination of the two currencies. And yeah, you're going to get exchange rate indeterminacy out of this. So I took sort of as my challenge to sort of think about a world where, we end up producing trades which look like country-specific cash and advance constraints, but are not achieved by imposing cash and advance constraints.
But my claim is
But
that's
it's certainly right that if you want to take this, take the policy implication is intimately connected with saying we're achieving, trades that look like, money one is used in country one and money two is used in country two. If you want to depart from that, yeah, fine.
No, but it seems to me that that's the critical assumption. It's not the Lagos right, the quasi-linearity, the two-state restriction. I think that is the key. That's as long as you have that, your results are going to be robust across, I think.
That might be.
Chari, you have a question?
Yeah, more an observation. This is a little bit, Neil, following up on what David Andolfato was saying. It's a point I've tried to make in at least one of my papers. I was trying to figure out how you got around it. Here's the proposition. Suppose that the issuers of currencies have complete commitment and can cooperate. Then describe two regimes. One regime which potentially allows the relative prices of say, two currencies to be different in some state at some date. Call that a flexible exchange rate system. Another where they're required to be constant across all dates and states. So the theorem in that context was that a system which allows exchange rates potentially to be different, but does not require it to be equal across dates and states, must weakly dominate any system which forces equality at all dates and states. There's a separate question about whether you can get strict inequality here. Oleg Itzhaki in his discussion was raising some of that. What I was trying to figure out is, where does my theorem, which I thought was right, until I listened to your paper, I'm still not quite sure, like David, exactly what ingredient failed in the logic of my argument to say that as long as the issuers, I think this is critical, they can commit and that they cooperate. Why isn't the set of equilibria weakly larger under, I'll call it flexible exchange rates if allowed to, rather than required to have fixed exchange rates?
Yeah, I think that's kind of related to David's comment. It's right that I'm getting this difference between exchange rate systems by imposing no substitution in currencies. I'm imposing that you've got to use the producer's home currency to make a transaction. And, so you could say, so you could ask, well, why impose that? You're, and you're not imposing that. And yeah, and so, so that's certainly a restriction that I'm imposing. And I think that's, why your theorem doesn't apply.
Oh, I think that's really cool. I like this great quote that I saw from John Stuart Mill, writing in the 19th century. He says, "It is a barbaric practice that every nation seeks to have its own currency." He thought that it was barbaric. There was a return to, I guess, times before when Britannia rode the waves. I thought that was very interesting. A fine economist, and in sharp contrast, Milton Friedman, another fine economist, said it's a barbaric practice to force everybody. He didn't say it's barbaric, but he said the equivalent to force all countries to have fixed exchange rates. And I think your paper helps contribute to that, to the extent that it focuses on the key thing, which is substitution, which I think is a nice, very useful, important point to make. So thank you.
All right. Well, thank you very much, Neil and Oleg and participants. Let's close this session, and we're almost back on time. And I surrender the reins to Lars for the next session.
Great, thank you very much. Tim and Juan Pablo asked me to say a few words about this very impressive monetary and fiscal history project of Latin America, which they've, which Tim will be elaborating on and sharing more information about this. My role in this project was kind of interesting in a sense. I became aware of it in 2013, and I think my primary role was to secure funding for the project in my capacity when I was the director of the Becker-Friedman Institute, and also a cheerleader as well. This project has very interesting origins in the sense of I gather that it's the brainchild of Tim Wampa and also Tom Sargent, in which the idea was to go kind of beyond researchers producing their own little discussions of each country within Latin America, but to figure out a kind of a common framework, measurement framework by which way that we could assemble data and write down kind of a common modeling framework in order to interpret that data. And hopefully opening the door to interesting studies going forward about making comparisons across countries and learning more from Latin America history about monetary and fiscal histories. And it was kind of interesting to watch this unfold. As I say, I first got involved in 2013. There were times in which I thought it was never going to end, but it did end. There was a remarkable number of conferences in many different Latin American countries. There were conferences at the University of Chicago and elsewhere. I was specifically actively involved in two of the launch conferences, including one at the Bank of Chile and the other one is at the International Development Bank. But it was very impressive to see a study whereby we had, where kind of Tim and Juan Pablo secured local experts, economists in these different countries that knew a lot about the details, but then got them kind of reined in to be thinking about common frameworks in order to be putting things together. And the conferences, they also did a remarkable job of recruiting very high quality discussants. And I think the discussions were, at least I found tremendously useful. So the end result is there is now a book coming out. There's chapters on 11 different countries. There's discussions of that are informative of these different countries, and it'd be very exciting to the extent that this can open the door to lots of comparative research. And I should say that, from the standpoint of my own contribution, there was also very important staffing contributions here at the Institute. The kind of the communications director, Karen Anderson, was really centrally involved in making all this go. And then Diana Petrova, the current executive director of the Macrofinance Research Program, has just been centrally involved in watching this in not only the conference organizations, but in terms of the getting the book ready for publication. So it's been a massive project, but I'm very pleased that it's ended in a very good place. And with that, I'd love to turn the stage over to Tim.
Thank you very much, Lars. And I'm very honored to have been asked to speak here today with such a distinguished group of speakers and excellent papers. And I'm especially honored to have Lars as the chair of this session. Now, he's already given his version of the story to you, and it kind of matches mine. But mine says that in 2013, when Juan Pablo Wampa and I had been thinking about this for about 3 years, and we were a bit in the doldrums. Lars gave us financial and moral support to keep this going. Now he's right, we always underestimated how much time different stages would take. But if he was skeptical that we'd ever get done, that didn't stop him from giving us support and then keep pushing us forward. So this is a book, it's gonna be, it's 700 odd pages long. There's the cover of it. It's the economic history of 11 Latin American countries, separately, but using a common government accounting framework that we've adopted from Sargent's Rational Expectations and Inflation. And in Tom's talk this morning, when he said that he expected me this afternoon to use a more elaborate and detailed budget constraint, I thought to myself, how does he know I'm going to do that? And then I remembered, well, Tom has rational expectations. Okay, so these 11 countries, turns out Uruguay is smaller than a lot of countries in Central America, the Caribbean, but they came together organically over time. We certainly did start with the 6 largest countries, and then we added the other 5 just because of personal contacts. 4 of the team leaders in different countries are former students of mine from the University of Minnesota, for example. So as well as these 11 chapters, what's in the book? Well, there's a foreword by Francois Beldy. Fernando Alvarez, Lars, and Tom Sargent contributed a really great chapter, kind of putting what Juan Pablo and I were working on in kind of intellectual and historical context. Wampa, Tom, and I adopt, and I'm going to get into this a bit, the kind of framework that Tom had developed for thinking about the United States in the 1980s into something we can use for Latin America. And I'm going to stress the couple essential differences. And finally, we have a chapter at the end that we put some work into with Carlos Esquivel, who's now a professor at Rutgers University, but was a grad student working with Wampa and me here, drawing conclusions. And Carlos did such a great job helping us, pushing the project and so forth, that we decided that he just had to be a co-author of that. So a lot of what I'm going to talk about right now is the specific paper, which is a Fed staff report by Carlos, Wampa, and me. The book, there have been delays. Recently, it's all supply delays connected with COVID and the academic printing industry. But it's supposed to be available this month from the University of Minnesota Press. You can order it from their website. And if you don't happen to jot this down, if you want to get it, they have a promotional code that'll make a book we're hoping to be able to sell a lot of these copies in Latin America. At some point, we'll want to translate into Spanish and Portuguese. But the price of the paperback is going to be $20. With 40% off, that's $12. So you might want to take a look at this. Okay, we start by reflecting just on a view that was common in Latin America in the 70s and then got worse in the 80s about the great economic tragedy that occurred. And so the epigraphs, we have two epigraphs to the book, and they're from one person, Eduardo Galeano, the Uruguayan, who wrote a very famous book on the open veins of Latin America. And he's very much identified with the left. And he was very disappointed where Latin America was, and he blamed it on first the Europeans who exploited Latin America and later the gringos. And he says, el desarrollo es un viaje con más naufragos que navegantes. Development is a trip with more shipwrecks than navigators. Now, at the opposite end of the political spectrum was Mario Vargas Llosa, who later, of course, was one of the top novelists in the world, but later became a politician, identified with the right. And in his very famous novel, Conversación en la Catedral, he asks, ¿en qué momento se había jodido el Perú? In exactly what moment did Peru screw itself, to use more polite language than Vargas Llosa did? And it was, people were depressed. Latin America, where in the 50s and early 60s, people pictured it might be one of the fastest growing regions in the world, just ran into trouble. And they had very different viewpoints, Galeano and Vargas Llosa, but they were similarly depressed. So what's our hypothesis? And now we're going to see why it's so related to the topic of this conference. In fact, except for Wampa's connection with the University of Chicago, I wanted to remind you of the great book by Friedman and Schwartz. We could have called this the unpleasant monetarist arithmetic of Latin America. Periods of poor economic performance had coincided with periods of financial crisis. Now, the financial crisis, and you'll get a little bit of an idea from my discussion of the budget accounting for Mexico in the 80s. But yeah. Hello? Oh,
just carry on.
Yeah. Okay. So the crises took very different forms, and they had high inflation rates, balance of crisis, payments crisis with large devaluations, banking crises, sovereign default, confiscation of deposits, private deposits in banks. But our fundamental hypothesis is that despite all these different manifestations, all the economic crises in Latin America since the 1960s are the result of poorly formulated, poorly implemented fiscal policy. So let me take a look at a very specific episode. It happens to be very specific, but it happens to be very important because it is the crisis that led all of Latin America, what we call the lost decade, la década perdida. So we found in common throughout our 11 countries, countries that had done well in the 60s started making all kinds of policy mistakes in the 70s. And finally, in the 1980s, the chickens came home to roost. In 1982, Mexico suspended payments on its external debt denominated in dollars. And it was debt mostly to Americans, that is New York banks, some to UK, that is London banks. And it was excluded from international financial markets until the implementation of the Brady Plan. In short order, most of our countries defaulted on the debts. And Latin America entered a depression of the same order of magnitude, in some ways worse than the United States, North America during the 1930s. We're going to use a government budget accounting to narrate a role for fiscal and monetary policy in Mexico during the crisis in '82. So I hope this will remind you, I'm not quite as artful about this as Tom Sargent, as what Tom Sargent did for us this morning. He took some graphs, and I'll have a couple graphs, but I'm going to look at it in a budget accounting equation in a little bit more detail. And then I'm going to give you a narrative, and we're going to see the narrative is complex. It was fiscal irresponsibility, but some other factors played roles. Mexico for sure had large primary deficits leading up to the crisis. And in 1982, we'll remember that Paul Volcker drastically increased interest rates. And there's a standard narrative that say, well, the huge deficits followed by this interest rate increase made it difficult for Mexico to pay service its debt. Now, I'm gonna mention briefly work that Wampa and I have done with Carlos and another former student, Victor Almeida, who's now at Carleton College, that showed that that's not our story at all. But I got to give you some kind of story. Another thing that happened was the price of crude petroleum fell in 1982. Okay, so yeah, as Tom promised, my government budget constraint is a little bit more elaborate than his. It includes in particular 3 additional terms. And what are they? Well, here's the thing. Latin American countries borrow in their own countries sometime, or almost exclusively in the case of Argentina early on, or Chile early on, or even Brazil in later periods. But most of them also, at least up until the last 10, 12 years, borrow in dollars. So those are those additional terms. I have peso, I'll call them pesos, but whatever the local currency is, debt, and then I'll also have dollar-denominated debt. And then Tom was telling us this morning why his measures of debt were not perfect because they were par values rather than market values and how he adjusted it. We have a worse problem. In some periods, in some countries, our budget just doesn't hold. There are either implicit taxes or much more commonly hidden spending that makes the budget unbalanced. Now, we know what the sources of these things are, but try as we might, for most countries, we just could not really nail them down in finding any accounts. In the case of the chapter on Bolivia that I worked on, the co-author I started with, a really fantastic young guy, Carlos Gustavo Machicado. He recruited an economic historian, Jose Perez Casillas, to help us out. And we were convinced that this residual term here was mismeasured losses from government enterprises. And everybody in Bolivia said, oh, that sounds right. He went and searched through and found the books. Remember, this is an economic historian, and he's used to looking at things from hundreds of years ago. He could find books, so-called accounting books, from 40, 50 years ago, and he still couldn't make head or tail of it, and he still thought most of the information was missing. So let me move along with this. I'm going to do rearrangements exactly like Tom did this morning, except there's more terms here. And what I do is I measure everything in terms of nominal GDP. Current price GDP, they're going to be stocks and changes in stocks and current prices, and I'm going to divide through by GDP. Okay, then there's a problem with the exchange rates we're going to get to in a minute. You're not supposed to memorize all of this. This is in Wampa and Tom's in my chapter where we lay out this, this whole framework. What we did do, and it took some work, and Juan Pablo is the former rector of the Universidad Torquato di Tella, is kind of better than me at bossing people around. I kind of try to coax grad students to do what I want them to. But we were able to get our authors in our chapters to rein in all their ambitions to do wild new modeling and get them to follow this and put their narrative in terms of this budget accounting. Okay, so here's the budget accounting for Mexico. And I'm not going to ask you to read through every line. However, on the top line on obligations, we have the primary deficit for Mexico. And you see leading up to the crisis, it was about 5.5% of GDP per year. And that's large, although as Wampa likes to point out, when we look at happened to Spain, for example, leading up to it's almost getting buried by the EMU debt crisis, there was far bigger numbers than this. What I want you to focus your attention on is this last line. We call it the transfer. But these are the numbers that must have been the hidden spending, obligations of the Mexican government that we kind of know what it is, and I'm going to give you ideas, but we can't really quantify it except by finding it as a residual. So this number is averaging 10% during the crisis and following. Far bigger than any other number in the table. Okay. So what happened? Mexico had its first devaluation in the modern period in 1976. And they didn't want to ever do that again. So the government of Jose López Portillo, the president at the time, they just were promising not to devalue. But people were getting nervous because the government was running these big deficits. Finally, in 1982, early in the year, there was a devaluation, and López Portillo used that as an excuse to get rid of his Secretary of Finance. Then in 1982, there was another one. The government took over the banking system. Levels of debt, private and public, were often denominated in dollars. With the devaluations, it really shot up. And that was the crisis. I'm sure Juan Pablo, from hearing me talk about things in the past, is worried because, you know, I was spending the summers of 1981 and 82 at the Banco de Mexico working on a project with my friend Jaime Serra and Leopoldo Solis, who was the director of research at the bank at the time. And I'd tell you all kinds of stories, details about this. I'm going to skip those. But this was a very, very painful period. I've already mentioned the huge levels of transfers. So the governments in these countries find ways. This is a common, not all countries have this transfer problem, but a number do. The Mexican government had a huge bailout of the banking system because the banking system was promising depositors dollars, but it was making loans in pesos. There's a devaluation, there's problems. We have very poor accounting for profits and losses of public companies. That wasn't at that particular time the biggest problem in Mexico, but it was, for example, in Bolivia. All of these countries had government-run what they called development banks, which sometimes made crazy loans and just lost lots of money from the government. Maybe it was just expansionary monetary policy. There's a number way of looking at it, but you can't find it on the books. Multiple exchange rates lead to huge implicit taxes and subsidies on private agents, and I'll mention that in the beginning. Now, Mexico didn't particularly have these problems, but countries like Argentina, Peru, Brazil, that have hyperinflation. The worst year for Mexico was 150% in 1987. Have this problem if they do the spending at the beginning of the month and paying with taxes collected towards the end of the month. There's actually a huge deficit because the value of the pesos changed so much. This, of course, is the Oliveira Tanzi effect that people talk about. We found, interestingly enough, in Brazil, people on our team kept talking about the reverse. Somehow Brazil found a way of doing it the other way, which was good, collecting taxes and then waiting a while to, no, it was not good, it was horrible, but they collected the taxes and then they spent it later. Here's an important point. The IMF is always pushing countries to do this. You can just, institutional reforms can actually fill in these gaps and erase that X term. In Mexico, for example, the average transfer during the 80s was almost 6% of GDP. Afterwards, it was less than 1%. Argentina, Brazil, Chile, Paraguay, Uruguay have also eliminated those transfers. Now, my co-authors and I think of these reforms as essential because suppose you can get the government during a period of multiple exchange rates to give you the preferential exchange rate. I'm about to talk about that in a second. That's more valuable than any productivity enhancing innovations you can do in the firm. You have all the wrong incentives in a world like that. Right? In 1982, the net giveaway of the Mexican government in things we cannot account for. We know where they were, but we can't account for the numbers. To favored private agent over unfavored agents was almost 14% of GDP. Here's what happened in Mexico. I already mentioned in early 82, they had a devaluation. Now, I'm sorry, I've given this talk in a number of countries in Latin America. I translated everything from Spanish to English, but I forgot to fix the labels on the graphs. So we see the big devaluation back in February, March. Then some of the desire to stabilize. And then finally in August, we start getting at some point 3 different exchange rates. Later on, officially, there were multiple exchange rates up to 1995, but really they disappeared after the mid-1980s. But what happened? And what's the order of magnitude difference? Well, at some point in 1983, look, some people are paying 50 pesos for $1, and other people are paying 160. These are wildly different exchange rates. Who are the people? Well, during that 1982, when people were getting nervous about a devaluation, Mexican middle class put their money into Mex dollar accounts that promised to pay them in dollars. After the devaluation, the Mexican government took away half their life savings. That happened to my friend Jaime Serra's parents. There were implicit subsidies. Who got to buy dollars with only a few pesos? Large Mexican companies. Okay.
Hey, Tim, this is Lars. You might want to wrap up soon so people would have.
Yep, I'm going to do it right now.
Excellent.
There are 2 different ways we could have done the government budget accounting in terms of measuring changes in foreign debt, but they only would change 2 lines here. It would increase the foreign debt issuance, but it would also increase the foreign debt service in terms of those lines. It wouldn't have any effect on the transfer. Okay. Neil could ask me, as he was asking Tom this morning, where's the model? In our introductory and conclusion chapters, we talk about all kinds of ways we'd like to see people model this, but we haven't. This is narrative, it's statistics, it's databases, and it's narrative. We're going to leave the modeling to other people, but including ourselves. So we have a model of sovereign default renegotiation, where we argue it wasn't the Volcker shock itself the direct effect on increasing debt service. It was the anticipation by the Mexican government that they'd have an easy job of renegotiating their debt with US banks. They didn't, and that's an interesting story. And so I'm going to leave you to read the paper. But we're excited about the book. There's lots of stories in it. There's lots of interesting data. And remember, if you order it during the month of November from the University of Minnesota Press, you'll get a 40% discount. Thank you, Lars, for your patience. Yet again, you're being patient with us.
Okay, I guess it's open for comments and questions.
Good.
Sorry, is it open right now, Lars?
Yeah.
Yeah.
Oh, I'm so sorry. I can't see there. Okay, Tim. So, oh, wow, that's a lot of stuff. I'm looking forward to reading that book. So I was just wondering, so are you suggesting, I don't know if you've ever thought about this, but just imagine an hypothetical world where, I don't know, issuing dollar-denominated debt was prohibited.
and go back and rerun history, everything kind of more or less the same. I mean, and you're imagining that this reform in of itself would have probably not had much of an effect on the ensuing crises. And if so, I kind of find that I'd be skeptical of that. But what are your thoughts?
No, well, a typical crisis, but no crisis is completely typical here, is that there's some kind of populist pressure that pushes the government to spend more than it can collect in taxes. And for a while they borrow. Sometimes they borrow in their own currency. More often, at least during the 70s and 80s, they were borrowing in foreign currencies. And then they hit some kind of borrowing constraint. Then they print money, and they get into a mess. So no, we think that the problem is just chronically spending more than taxes you can collect.
He's speaking more to the view of the original sin literature that's the
right.
David was speaking to. I think he's asking you for your view of that, namely that if you put your stuff in a foreign currency, you can't inflate it away when push comes to shove. But if it's in your own, you can. And there's a bunch
right.
of papers viewing. He was curious what you thought. I think that's what David was asking.
Right. No, that's right. That's right. And David and I were even in a discussion about this the other day with talking about the neo-chartalists or the MMT people, as we call them. And, there's kind of two claims there, and they're interdependent. That monetary expansion, as long as you have unemployment or production below capacity, will not be inflationary. I mean, if you look, I don't know how you can think that looking at the United States in the 1970s, but for sure, if you look at Latin America, you can't think that. And then, there are people say at least as long as you're not at full employment, if you have your debt in your own currency, you can't run into a financial crisis. And we have examples from Argentina, from Chile, from Brazil, where having domestically denominated debt doesn't help you at all. The crisis takes a slightly different form, but it still happens. I don't know what to say. And Patrick, as you'll remember, I started working on trying to figure out these crises back in 1995 when Mexico ran into trouble. And modeling sovereign debt crisis was kind of a small field in Latin American economics. And then the EMU crises came along in 2010, 2013, and my human capital shot up. Same for you, Manuel.
The value of your human capital shot up. I'm not sure the quality of your.
Oh, no, yeah, good.
The price went
That's
up.
right. The value shot up.
Okay, I think Chari. I think Chari is next.
Yep.
Sure. Hey, thanks, Tim and Wampa and all the contributors. This is phenomenal work.
Oh, and just to in this room right now, in this virtual room, I'm counting at least 10 different contributors to the book. It's like an army of economists we got working for us.
Thank you all. I really, really appreciate it. I was thinking about the stories about what you were telling. Spending dramatically more in revenues than you take in, engaging in bank bailouts on frequent occasion, lots of dumb microeconomic policy. I don't know. The first country that comes to my mind when I think about those kinds of policies is the United States. The second country might well be Japan. So I think that this is more for the students, I suppose, and those, including me, who hope to work on these kinds of things. It's a lot easier to tell a story about one collection of episodes. The real challenge is trying to show when there is enough of a difference and what the fundamental sources of difference are, why countries that seem to have followed almost exactly the same irresponsible policies just get away scot-free. And that is the real challenge. Not that I'm asking you guys, again, thank you very much for doing this.
Yeah,
Let me jump in.
We have two more questions from Ramon and then from Pat, and then I'm sure we're out of time. I mean, unless you want to respond to Chari, Tim.
Very quickly, I would like to say, if I show you the data for primary deficits of Argentina and Chile and some other countries in the 70s, the US didn't beat that yet.
I was thinking about the last 20 years.
But I take your point that there are other differences that need to be addressed.
Okay, Ramon.
Thanks, Tim and Juanpa. What do you think on this has been the role of the lenders, the IMF and so on? I mean, those people understood some of these things, but money was flowing.
Well, that's part of the narrative that in our subsequent work, we tell about what happened. We tell about what happened in loans to Latin America in the late 1970s. So this is from we get a lot of information, both from the history of the Fed and from Bill Seidman, the guy who was the chair of the FIDC under George Bush, or Reagan and George Bush, and he had worked in the Reagan and Ford administrations before that. He said in the late 1970s, the Fed and Treasury decided what U.S. banks needed to do is, the world was awash in petrodollars. They needed to find somebody to borrow the money at a decent interest rate. And they thought Latin America would be a great place to lend the money. And when we talked to Al Harburger about this in Chile, he said he remembered it was tough to get a hotel room in Santiago at the time because there were so many US bank representatives there trying to lend Chile money. Then 1982 happened, and the people at the Fed realized that if the banks, 4 major banks in the United States, would actually admit to having lost all the money they had lost in Latin America, that the US banking system would be in trouble. So they kind of froze the loans. They said, we're going to call these loans as still performing because we're going to lend the money directly to Mexico, and we're going to get the IMF to lend the money to Mexico. And the only thing they can do with the money is make payments of interest, so that we can pretend those are still functioning loans. Finally, in 1989, the banks had had time to recapitalize, and they instituted the Brady Plan. But I think in that case, the US government and the Fed are partly responsible for what happened. Of course, the banks, they didn't have to lend all their money to Mexico and other Latin American countries, but they did.
Thanks.
Okay, we have Patrick, and then Tom Sargent will close it.
Okay, this is a nerdy question. I feel embarrassed asking me, so I'll make it quick. What always confuses me with those budget constraints is long-term debt. If I owe you something in 20 years and the value that's going up and down, and I don't have good market values for what's doing, because a lot of it isn't really valued, conceptually in an accounting sense, I'm getting more in debt, less in debt, more in debt. But in terms of a cash flow month in, month out as a government, money in, money out, it's not really affecting it. So when we were messing around with Brazil, it always confused me what you do with that. And then if those swings are big, some of that, I don't know, some of that stuff you have could be swings in something like that, but it's like a conceptual accounting framework more than a cash flow framework that someone actually has to give up money, not pay money. So don't even answer that. Let Tom just go ahead, unless you want to.
Wampa? That was related to what Tom was talking about this morning, looking at US debt. And it turns out that he and George Hall were able to do a reasonable job going back and looking at the market value of the debt rather than just the face value. And Patrick, given that you were part of our Brazil team and we're working on this, that is so far beyond us. We're worried about our budget accounting has even more immediate problems than that, but you're 100% right.
Okay, Tom?
Yeah, this last point by Tim and Pat's point, I'd like to talk about it sometime when we see each other. Yeah, actually, we had this discussion with Chari 10 years ago at one of the conferences that Tim organized at the Minnesota Bank. But I can't articulate it clearly now. But there's one thing when Tim was talking about a country that a pattern where you see a country persistently spend more than it's taxing, run up these deficits, and then runs into a train wreck. So there's a history book. It's actually History Political Science by Francis Fukuyama. It's a pair of books. One's called The Origin of Political Order. There's versions of Tim's story in there. So I'll just mention two versions. It talks about Spain in the 17th and 16th and 17th century, and fiscal arrangements in a train wreck that Spain runs into. And then he talks about another one in France in the 18th century that has all the components of Tim's narrative, and the outcomes are not good. At the time France had this, it was the strongest country in the world. So this arithmetic has, the outcomes were resolved in a political revolution that rearranged fiscal things. But I'll just stop there.
Tim or Juan Pablo, do you want a quick last word? Or?
Well, since I had most of the beginning words, and Wampa and I are still equal partners on this. In fact, he's kind of more the boss of the problem, and I'm the working man. Wampa, why don't you have something to say?
Just it was a great opportunity to have this chance to talk. The main motivator for the project was Tom's and Neil's work on budget constraints in the early 80s, and maybe Tim is right. Maybe it should not have been called a monetary and fiscal history. Maybe it should have been unpleasant monetary budget constraint arithmetics. So thanks a lot, Tom and Neil, for what you have done. And given that I'm the chair for tomorrow morning and that we're a little bit late, I guess I can call it off for the day. Thank everybody for participating, and then see you tomorrow in the morning.